Yes, a very good morning, guys. Can you please confirm if the screen is visible and you guys are able to hear my voice? Please confirm in the chat. Okay, okay, fine. So today we're going to cover the remaining chapters of FMP. That is the important remaining chapters of FMP. And there are in total 8 chapters in the agenda. Okay. Now let me tell you, there are three chapters approximately, which will take a little bit more time, and 5 chapters which are comparatively simple, like we'll be able to complete it within 30 to 40 minutes of time period. So considering everything, I'm assuming today's class will go up till I think 5 p.m. if I include all the breaks that we will take in the between and so on. Okay. So without wasting any time, let's start the session. So our first chapter that we're going to discuss today is FMP1, that is banks. Okay, now we all know that whatever we have been studying is actually in a way related to banks. So we need to understand what banks are, how do they function, what types of banks are there in the market, what types of risks they are exposed to. Okay, when they are into the market doing their day-to-day businesses. Okay, so these are the objectives agenda that we'll try to cover in this chapter. And roughly from the examination point of view, this is a very easy chapter. Let me tell you, it's a very easy chapter, and approximately 1 to 2 questions you can expect from this chapter as well. Okay, minimum one question will be there. So if let's say you manage, to read this chapter or just understand the theory properly, you will be able to get that one answer, one question correctly. Okay, thereby increasing the chances. Now let's start. So what is in this chapter? First, we'll understand the introduction, like how the banking evolved, what were the things. Okay, so if we talk about the evolution of banking, so bank has evolved beyond the traditional roles of deposit taking. Like initially when we talk about the banks, their main objective was to take in deposits and then using that deposits make out loans. Okay, but now it has changed. Okay, now we see that we have commercial and investment banking as well. Okay, where uh, raising money is not done only through taking in deposits. In fact, there are multiple ways, like issuing bonds, commercial papers, things like that are ways to raise money, and then that money can then be utilized to give out loans. So there are multiple ways. Investment banking, for example, if I talk about commercial banking, where large corporations generally are the clients of the bank. Okay, large or corporations who take a large amount of sum of money. Okay, investment banking have multiple roles. They take up advisory roles. They advise companies on what to do, because these are the champions of financial world. Okay, they know how finance function. They are the preachers of money in a word, in a way I can say that. Okay, so they know how money functions, so they are in a very good position to advise the companies who don't have that expertise regarding the financing decisions or regarding the financial investments, whatever it can be. Then they also take into the picture, they also take up activities like facilitating trades. So basically they act as intermediaries, dealer banks, matchmakers, market makers, you can call them. All these activities are now taken upon by the banks. So this is how they have evolved. Next, we have the commercial banking. So commercial banking basically involves taking deposits, lending money, and providing other services. It can be retail commercial banking, where small deposits are taken, which are retail banking. We are all aware of, like the banks that we usually go. Okay, that is retail bank. Okay, where we make small deposits in, like, what it can be, and not more than, even if let's say you are in a good income range, not more than 2-3 crores at max. Okay, so these are small deposits when we compare to the overall size of the bank. So it comes under the retail banking division. Then you have the wholesale banking, where services are provided to medium to large corporation clients. Okay, there the client actually become not the individuals but the corporations, the companies. Okay, who can be mid cap companies, large cap companies, things like that. Okay, now, cost in wholesale banking is low due to the economies of scale. It is understandable. So just consider one scenario. Let's say we talk about retail bank. Okay, so in retail bank, what happens if let's say bank is giving out loans? We are not talking about on the deposit side. Okay, let's say the bank is giving out loans. So in order to do a business of 100 crores, it is possible that they will have to give out maybe um thousands of loans. Okay, but when it comes to corporate clients, and if there are thousands of loans, you need that many people to handle such loans. Okay, to assess the risk profile, their infrastructure will be needed to have to maintain the records and all. Okay, so that increases the cost. But when it comes to the corporate clients, so doing a business of 100 crore might require only one or two corporate clients. Okay, in order to do that 100 crore business, so their handling is easy. You can have minimum number of lower number of personnel required, less infrastructure cost is there. So there you have the cost. In the case of wholesale banking, if they are able to give out loans at a lower interest rate, it's because they are able to ensure that their costs are less because of the economies of scale. Next, money centers, banks who are heavily involved in wholesale banking and fund lending, okay, through financial markets, are called money center banks. So they usually don't take upon the activities like taking in deposits and things like that. Okay, be it in the form of FDs or savings account or current account, whatever. Next, we have the investment banking. Investment banking actually help companies, other companies, okay, because investment bankers, as I said, they are the champions of finance. Okay, so they know everything about money, and they know what they are aware of the rules and regulation, financial rules and regulation within the region. So they help other companies who are new to this, who don't have that capability to raise capital. Capital can be raised in two forms. First is debt, second is equity. So they can help it in either way. They act as underwriters. In case of equity, they can help initiate the IPOs, or let's say Dutch auctions can be done. The Dutch auction actually usually does not involve investment banking, but yeah. And what benefit we get? Why do we go through them? First, they have the expertise. Second, they have the clientele. Okay, that means they have huge number of investors who are actually the direct clients of investment banks, and they can easily facilitate this transaction of raising money. Okay, they also advise on, like, they take upon advisory services where they help us with mergers, acquisitions, and other corporate financial decisions. Okay, next is they also facilitate securities trading. This security can be anything. Okay, it can be bonds, it can be equity, it can be derivatives, anything. Okay, they facilitate the trade. They basically act as brokers, and in return for the services that they provide, in return for facilitating the trade, they just charge certain commission. Okay, now, let's understand the risks in banking. What are the risks these banks are exposed to? In fact, if they are into money managing and everything, okay, they are into securities trading, they are helping clients doing things. Okay, they are giving out loans, they are taking in deposits. So there are definitely certain kinds of risks which are major for them. Okay, and three major forms of risk for them are credit risk, market risk, and operational risk. Okay, credit risk because they are giving out loans, market risk because uh, they are into they facilitate securities trading, so they have to maintain inventory at all times. And if they are maintaining inventory of financial assets, so those financial assets are subject to market variables. If the market variables change, those assets value can change, and it can lead to losses for the banks on paper. Okay, it can lead to losses for the banks, so they are exposed to market risk. And sometimes they also directly engage in market activities, in trading activities for their own books. That can also give rise to market risk. And finally, operational risk, which has taken precedence over the last 20-25 years, I would say. And operational risk is really understandable, because if you are doing any kind of business, if there is a human error, or let's say system failure, or let's say a fraud, all these things, or let's say some compliance issue, some legal issues, okay, some cyber threat, all these things can lead to losses. Okay, and that's why operational and all these things actually come under the purview of operational risk. We have read it in the operational risk chapter. So that's why it becomes really important for us to understand these three types of risk and what are the exposures. So if I talk about the credit risk, it is basically the risk of counterparties defaulting on loan or derivative transactions. So sometimes what happens for loan, it is understandable. Like, okay, uh, um, what can I say? For loan, it's like, okay, you have given out the loan, so you have a positive value. It's an asset for you. Now, if the borrower fails to pay the obligations, borrower fails to pay the EMIs, you will lose money. Okay. On derivative transactions, again, we have studied derivatives can have positive value. Whenever it has positive value, that means you will receive something in return. Okay. You are on the positive side, you are on the receiving end, you will receive something in this derivative transaction. Now, if let's say the opposite party fails to make that payment, it can be in cash or cash equivalent, it can be in any form. Okay. Let's say they fail. Again, that's the default. That's technically a default, and that gives rise to credit risk. Now, banks account for expected losses, and that's why these banks actually calculate expected loss. We have seen in the credit risk chapter that expected loss is calculated, and it is actually adjusted in the interest rate charged on the loan, okay, that they are giving out. So they calculate expected loss immediate on the transactions immediately, and if it is derivative, then they do CVA, credit value adjustments. Okay. So CVA is done. Now about CVA, you will study in detail about CVA in part 2 curriculum. As of now, we are just taking the overview that what are the risks. Then loan losses, actually, if I talk about, then they can vary depending upon the economic conditions. If the economic conditions are good, then we usually see that there are lower number of defaults, lesser number of defaults. But the economy is doing good, everybody has job, there is a proper flow of money. Okay, so people don't default on their debt repayment. But if economic condition worsens, then it gives rise to a higher defaults. Okay, so from in the US market, if you will see the range of default rates year over year, then it varies. The range is somewhere from 0.4% to 4% roughly. Okay, I don't remember the exact numbers, the exact digits, like is it 0.36% or something. So roughly I'm saying 0.4% to 4%. 0.4% when the economy is doing good, and up as high as 4% when the economies are doing bad, especially during the time of great financial crisis. We saw huge defaults on the loan obligations. Next, we have market risk. So market risk arises because of trading operations. Okay, when they do trade, they are exposed to market variables. These market variables can be anything: exchange rates, interest rates, stock prices. Okay, anything. There are multiple variables that can have an effect. So if these macro variables will change, this will lead to a change in the inventory value of the bank. Okay, if they are into let's say uh, market making process. Okay, so again, this gives rise to market risk, and they will have to manage it. Okay, the exposure arises because the bank act as market maker for such transactions. As I said, they act as market makers. They are the dealers. Okay, they facilitate the transactions, so they keep it in the inventories. Just imagine like this. I'm giving you an analogy here just to understand what market maker actually means. So let's say I'm a consumer. Okay, now I have to buy a pack of Maggie, and let's say there is Nestle who is manufacturing Maggie. So Nestle cannot directly sell it to me. There is a need of an intermediary. These intermediaries are shopkeepers. Now what these shopkeepers do, is it like if I go to a shopkeeper and I say that okay, I need a Maggie, then the shopkeeper calls the Nestle office and says that okay, send me one packet of Maggie. Nestle office sends one packet and then I get it. No, it doesn't work that way. What actually shopkeepers do, they maintain an inventory. Okay, so they will keep 50-60 packets of Maggie in their shop. Okay, and when I go to the shop, they will give me one. I ask for one Maggie, they'll give me one Maggie directly. Okay, so this is the inventory for that shopkeeper. Similarly, if imagine the banks are into trading, if let's say banks are facilitating trades, so in that case the thing is they need to maintain inventory. They need to keep stocks, all the types of stocks in their in their inventory, so as they can buy and sell these in the open market to the investors as and when requested. Okay, or as and when ordered. So it is inherent, as banks do not usually now. The thing is, in the case of market risk, is that market risk is inherent in the banks. Okay, and that's why they usually do not eliminate exposures of market risk. They keep their exposures open because they know that okay, if today is something bad, tomorrow will be good, and I'll be able to cover up that losses. But in order to cover up that loss, they keep in place risk capital. Okay, so what this statement means is that just because there is market risk, banks will not stop doing these kind of activities. Okay, banks will not stop acting as market makers, dealers, brokers. Okay, they will keep on doing it. It's just that they will try to manage in some way or another that, okay, whatever the risks are. They will not eliminate the risk. They will not go for hedging, especially for market risk in most of the situations, but sometimes they can. Okay, now it's finance decision that has to be taken by the bank's team. Okay, so that's a whole new discussion to do. But yeah, most of the time they do not mitigate it. They maintain capital that okay, if there will be a loss, I will manage it. Okay, using VAR, expected shortfall. We have studied all this. Finally, we have the operational risks. It can arise from multiple things. Okay, it can arise from internal system failures, external events like some kind of crisis happening somewhere. Okay, some kind of external fraud happening. All these things can lead to that, posing significant challenge for the bank. And this is really problematic because you cannot quantify it all the time. You see, thing with credit risks and market risks are that it can be quantified to an extent. Okay, but in case of operational risk, you don't know what will it be. So let's say you have an internal system failure. Let's say your net banking stops working for any reason. Okay, let's say your net banking services stops working for some hours. You don't know what will be its loss. What will be the loss because of it? You may lose the customer's trust. If it happens quite frequently, you may lose customer's trust, thereby leading to a situation where you are not even able to do businesses. Okay, so nobody can tell the extent to which the losses can be in the case of operational risk, and that's why it is the biggest challenge. Okay. Now, it actually includes, if I talk about the scope of operational risk, uh, what activities can be categorized under the operational risk domain or under the operational risk umbrella. So these are external fraud, employment practices, business disruption, compliance, cyber, legal risk. All these things are actually, they all come into the purview of operational risk. Okay. And in fact, if I talk about the major factors contributing towards the maximum of the operational risk losses, these are cyber risk, legal risk, and compliance. Cyber, they are constantly under the threat of hackers. Okay. Or cyber criminals who are constantly trying to breach their security in order to gain leverage, some kind of leverage, maybe access customer data, or maybe do some illicit transactions, okay, which is not authorized by the bank, or maybe even into money laundering or something like that. They can do anything, and that's the problem. Okay, so cyber risk is the biggest threat for them, and we have seen like cyber risk is actually huge, because I'll give you an instance here. A few years ago, what happened with Yahoo, there was a data breach, okay, security breach, and the hackers were able to steal the personal information of somewhere around, uh, I don't know, maybe it was, the numbers was in crores. Okay, some few crores of customer data, personal data was leaked. Their email ID, their contact number, their address, okay, their name, date of birth, things like that. Okay, those were leaked, and in a way, you would say that Yahoo was never able to completely recover from that, and it has not been able to reach that prime that it had before this hack happened. Okay, so yeah, cyber risk can have a huge impact. Then legal issues. So sometimes banks or these financial institutions can run into legal disputes. Okay, maybe with other companies, or maybe with the governments itself. Okay, there also, if the fines are charged, these fines are usually hefty. Okay, huge fines are there. So again, leading to abnormal cash outflow, which can disrupt the day-to-day operations of the business, okay, of the bank. Then third is compliance risk. Now, compliance is basically adherence to the rules and regulations established in a region. Okay, so if you are operating in certain region, you need to adhere to the rules and regulations of that region. If you are not adhering to it, again, that gives rise to compliance risk, because you're not complying with how the things are run in that area. So the regulators of that region will take action against you. Okay, and it's not that compliance issues always arise intentionally. Sometimes they happen unintentionally. You're not aware of it, that you are doing certain transaction, but you don't fully recognize that, okay, some part of this transaction can be considered illegal, okay, or may not comply with the local rules and regulation. Okay, and you did the trade. So here it happened unknowingly. You didn't did it intentionally on purpose, but you had breached the compliance. Now here also fines are possible. For regulators, it means nothing. Okay, even if you have done it intentionally or unintentionally, you have to pay the fine if you are found of compliance breach. Okay, so that's why they have their own compliance division, where the duty of that team actually is to ensure that whatever the bank is doing is in compliance with the rules and regulation of that region. Okay, next, if we talk about the capital calculations for different types of risks, majorly there are three, that is credit, market, and operational. So usually what happens, regulator use 1 year horizon for credit and operational risk losses. So whenever we are estimating operational risk losses and we are planning to allocate operational risk capital, or let's say credit risk capital, the time horizon is usually kept to 1 year. That we are talking about over 1 year, how much loss, what is the worst possible loss, or what is the expected loss that is calculated. But for market risks, time periods are very short, and you might have seen that when we were calculating VA or expected shortfall, the time horizon was as low as 1 day, and sometimes 10 days or 1 month, like that. Okay, but usually it is small, not 1 year, because market variables are more sensitive, and they can lead to severe circumstances. Okay, if not managed like on an immediate basis. Okay. Next, let's understand the Basel Committee, which is the governing body. I would say not the governing body, but I would say uh, a guardian body, I would say, which is whose duty is to make rules and regulation for the banks, which then the member countries of the Basel Committee can then implement in their countries, okay, separately, so that there is a common ground, everybody agrees to it, and overall financial stability, global financial stability, I would say, because we know that systemic risk do exist. Okay, so if let's say there are differences between the financial practices in one region and the another, then doing trade will become very difficult, doing financial transactions will become very difficult. Okay, so it's possible that maybe one trade that is marked as legal in one of the region might be considered illegal in another region. So disparity had to be removed. Multiple reasons were there. I'm not going to dive into the objectives why Basel Committee was formed, or BCBS, Banking Committee for Basel Committee for Banking Supervision. Okay, why this was formed, we are not going to that. But once it has been formed, so it was formed in 1974. The BCBS, that is Basel Committee for Banking Supervision, aims to facilitate international cooperation among bank regulators. Okay, so this is here what we have. There are member countries who become the part of Basel Committee, and these countries, the regulators of these countries, like in India we have RBI, in US we have the Federal Reserve. So these regulators actually sit together and try to arrive at some common grounds so as to facilitate international cooperation. Okay. First norms, I would say, not the regulations, but first norms were issued by Basel under the name Basel I reforms. Okay, and it was issued in 1988. Okay, and it introduced for the first time that okay, banks should have the concept that the banks should have capital requirements to cover losses from loans and derivative defaults. Okay, that means for market risk and credit risk, they should have capital requirements in place. Okay, specific capital requirements. For the first time, it was talked about. Prior to 1988, some countries had this structure, maybe because they realized that they were having a lot of losses. Some countries did not. So operation, like doing businesses was really difficult across region. And this was a time when we were seeing LPG happening, liberalization, privatization, and globalization. Okay, so this was the time when it was realized that okay, no, we need to have uniform structure of doing business across the world. Then next big reform came in the form of Basel II in 1999, which actually included uh, calculations for credit risk and op risk, which were revised, further refined, like over the period of 10-11 years from 1988 to 1999. Regulators were able to identify what are the problems with the existing model. Okay, and then they revised these capital calculations. Okay, and they also introduced for the very first time in 1999, operational risk was something about which the regulators talked that okay, we need to look into op risk and we need to calculate operational risk capital. And for them, they gave initially a very basic model like India. There was a called basic indicator approach. I think it was given most recently, but there was one more approach, basic approach. Okay, where just a certain percentage of your gross profit margin was meant to kept as your operational risk capital. And the reason was, although the reason why banks did it, why regulators did it was everybody knew that quantifying, even at that point of time, we didn't had that much theory that could be used to quantify operational risk. Now we have a lot. Okay, we have a lot of theories that can be applied to find out operational risk, although they are not completely precise, but still we have something. But in 1999 we had nothing. Okay, so people were like, okay, how we are going to do it? But the thing was, operational risks were a big challenge. Operational failures have led to multiple operational failures have led to multiple disasters in the past. So regulators said that okay, no matter what happens, you have to make certain allocation. Okay, and at that point of time, whatever best they thought was like, okay, if your gross profit margin is this much, average gross profit margin over the last few years, then certain percentage, maybe 10 or 15% of that gross profit margin should be kept as your operational risk capital. Okay, but later on it was revised. However, it took 8 years to finalize Basel II and implement it fully. Okay, it was not easy process. 8 years it took. Okay, there were multiple problems because of mostly because of operational risk capital. Then we saw the big thing happening, that was the financial crisis. Okay, now when the financial crisis happened, it was an eye opener for the regulators. Why? Because the thing was, at the time of crisis, I'll just take the example of the banks which failed, and the most biggest failure was the Lehman Brothers. So at the time of bankruptcy, that when Lehman Brothers was filing for bankruptcy, at that point of time, it was meeting all the regulatory requirements for whatever capital they had to keep, whatever ratios the bank had to meet. Everything was met up even at that point of time. Okay, Lehman Brothers was meeting up those requirements even at the time of bankruptcy, but still it failed. Okay, so they were able to realize that okay, the existing models that we have in order to estimate the risk capitals are not sufficient enough, and hence there was immediate action needed. So immediately we had a Basel II revision. Okay, and in that revision, it was basically considered as a reaction to the 2007 and 9 crisis, 2007 and 8 crisis. Okay, and revisions were related mostly to market risk capital rules. Okay, where we had initially VAR, but now from the crisis, from this point onwards, we saw a shift towards expected shortfall, or I would say coherent risk measures. We saw a shift towards coherent risk measures. Then we saw Basel 3, and it was a response to GFC only, Basel 3 norms, and it includes increased equity capital requirements for banks expected to be fully implemented by 2022. It was expected and it has been implemented in most of the countries. In India also, Basel 3 is done and dusted. Okay, it has been implemented. Then you have the FRTB, that is fundamental review of trading book. It was given out in sometime back, I think in 2018 or something, and it was due to be implemented in 2022. And that's why in part 2, you will have a dedicated chapter towards fundamental review of trading book. Okay, which is basically revised market risk rules, which enhances risk sensitivity. That means you are able to understand which all things in your trading book are more sensitive towards risk factors, how to manage them separately and others separately, rather than completely considering everything jointly. Okay, now there is a trade-off, I would say. The trade-off is like, one would say that if I have to consider everything separately, it will increase the cost, increase the risk capital requirement. And so people want to club things together. So yeah, in there also, in FRTB also, there is clubbing possible, but similar types of assets are clubbed together, not all. Then here you have the difference between standardized and internal models. There are two types of models proposed in the Basel norms. Okay, Basel committee says that, okay, you can use standardized models that is given to you by the regulators. Use that model, calculate the capital, and keep it as your risk capital. Another way is that you develop your own model. Okay, internal model, because each bank is different. They have different business model. They have different risk exposures. So parameters might be different. Okay, or maybe they use a different model all together, different assumptions altogether. Okay, however, it is equally valid, let's say. So internal models, when approved by the regulators, can be used to calculate risk capitals. So what is the reason that these banks will use internal models? Well, they have to put in more efforts, more employees, more personals, more technology, more resources. Okay, why would they do it? So there are certain clear differences between standardized and internal models. First is, and that is what is given in this table. Okay, so first feature is approval. Internal models require approval before using them. Okay, approval from the regulators in the region, from the regulators of the region in which you are operating. Standardized models are predefined tools. They are given by regulators only, that okay, use this, calculate the capital, and keep it reserved, keep it as a risk capital. Okay, so they do not require any kind of approval if you are using standardized models. Then the most important thing is the flexibility. Okay, flexibility. Internal models provide higher flexibility because they are developed by the banks themselves, so they know what they are doing in reality. So they can be flexible about what they are doing. But in standardized models, they cannot fluctuate a lot of things. They cannot change the assumptions altogether. They cannot tweak with the parameters to a large extent. Okay. Now, risk areas covered. What are the risk areas in which you can use internal models and standardized models? So before crisis, it was like for everything, you could use either standard or internal model. But after crisis, things have changed slightly. And now these internal models can be used to calculate market risk capital or credit risk capital if they are approved by the regional or national regulators. Okay. So the thing is, you cannot clearly, we have studied three major types of risk that the banks are exposed to: market, credit, operational. So naturally, standardized models should be used by only standardized models can be used to calculate operational risk capital. Okay, but for market and credit risk, you can use internal models. However, the condition is you are subject to regulators' approval. Okay, if it is not approved, then you cannot use it. Now, regulatory response was very swift. Actually, the Basel committee had aimed to reduce reliance on internal models, especially for operational risk. And if I talk about standard models, banks are not required to use standard models for determining formulas, calculations set by the regulators. They are like asking more and more banks to switch towards using standardized models. However, in today's scenario, also for calculating credit risk capital, a lot of banks actually use internal models. Okay, and I'll tell you, in the credit risk capital, we studied advanced measurement approach, where the objective was that we first find out the loss severity distribution, loss frequency distribution, then used Monte Carlo simulation to build the loss distribution. And once we had the loss distribution, we then calculate the 99.9 percentile value. Okay, that was our unexpected loss. Then, that was our extreme loss. Then, or you can say worst case loss. Then we subtracted the expected loss from the worst case loss to find the regulatory capital requirement. Okay. So the thing is, this model is still being used, although it is not used by the regulators nowadays, but banks internally use these models, and that's why we study this model in detail. Okay. Next is capital calculation. Capital calculations in standard models, we have predefined formulas that are set by the regulators, which can be used to calculate what will be the capital. In internal models, they allow actually to calculate capital. Okay, based on the bank's internal risk assessment. Like, okay, bank has assessed that, okay, this is their risk, and they can calculate the risk capital. Okay, but they have certain requirements that this risk capital that you are calculating internally should not be below certain percentage of the standard risk capital. So let's say, I'll give you an example. Let's say if a bank uses standard models, the risk capital should be $100 million, for example. Okay, now, while using internal models, let's say they find that the risk capital is, let's say, $20 million. So that's not reasonable. Even in the case of using internal models, regulators have defined that if your risk capital should be above certain percentage, above or equal to certain percentage of the standard capital. So they say that, okay, even if you are using internal capital, it should not go below 80% of the standard capital. Okay, so if using the standard model, what does it mean is that if using the standard model, your risk capital is $100 million. And let's say they define the threshold to be 80%. So even if you are using internal models, the lowest possible, I would say, risk capital that you can target to achieve is $80 million. That is 80% of 100 million. You cannot go below that. If it is below that, then they will say that straight away discard your internal model and say, okay, go use standard model. Okay. So that's the same thing that has been given in the last row. That is minimum capital requirement. There has to be certain percentage of the total capital. Okay. And by 2027, it is expected that the internal model capital should be bare minimum 72.5% of the standard capital. Okay. Now, let's understand investment banking. So banks which are into investment business. So what are their activities? First, we'll understand. So we have seen in the initial slides that major activity is raising capital for other corporations and governments. Okay. And this capital can be in the form of debt or equity. Next, you have financing arrangements, which involve originating securities, underwriting them, and placing them with the investors. They have a long pool of clients who are buyers of securities. So they underwrite the securities. That means they facilitate the trade. They help these companies get that money that is being promised. Okay, so that's what we call underwriting. Okay, bank becomes the underwriter. Bank is doing things on behalf of that company, and investors are not worried because now since certain bank is underwriting the securities, the trading. Okay, the securities, the investors gets a confident that if something bad happens, I have the bank. Okay, which can help me in this regard. Now, there are certain financing arrangements, like here we saw financing arrangements are there, which involves originating securities and writing them and placing them with the investors. So what are the types of financing arrangement? How do they do this activity? That if, let's say, I have to issue a bond, I'm a company, I have to issue a bond. I contact an investment bank, and so what they say, okay, we'll create a bond. This will be the structure. Okay, we will issue it on your behalf, and we will help you sell this to the investors. We have a large pool of clients to whom you can sell. Okay, we'll offer it to them, and if they find it fit, they will be able to purchase. Okay, so how do they do it? If this thing has to be done, what are the ways to do this? Okay, so there are basically two ways. First is the private placement, where things are, and second is public offering. In private placement, securities are sold to small number of large institutional investors, and usually government bonds and large corporation bonds are placed or are placed with the investors using private placements. So banks say that, okay, you want $100 million. Okay, right. So I have like these 100 clients who are high net worth, okay, who have a lot of money, institutional investors. Okay, and they will be willing, and so let's say for 8, 10, 12 mutual funds. Okay, we will offer them this bond, and it will be sold completely. Okay, now since these institutional investors or these funds have huge amount of money at their disposal, so they can easily buy large chunks of bonds. Okay, and raising money is quite quick. Okay, and it happens smoothly. There is no too much problem of price fluctuation and all, but this thing can happen. However, the loss side here is that the favoritism. Okay, banks may offer these products to their favorite clients, may leverage their position to bargain more with the companies who are issuing bonds, thereby giving them a downside. Then you have the public offerings. Now, public offerings are also of two types. First is firm commitment, second is best efforts. Okay. So in firm commitment, what they do, bank actually buys the security. So bank says that, okay, you want to issue $100 million of loans. Huh? Okay. So you take this $99 million. Okay. Now it's my duty. I will sell it at what price I can sell. Okay. So here I get the promised amount and I'm out. Okay. Now the bonds that the bank has underwritten, all the bonds, now the bank will sell it. If the bank manages to sell it at a higher price, then of course it's a benefit for the bank. But if let's say the bank cannot manage to sell it at a higher price, then whatever loss happens, I have nothing to worry about it. Now the bank will consider, because the bank committed me. Okay. So here the same thing, if they are unable to sell securities, bank end up owning them. Okay. And let's say it's the worst thing happens, they are not able to sell them. Let's say investors do not buy all of them, only 50% of the bonds were sold and 50% still remaining. So the bank will have to keep it in their own books. They can't do anything because it was firm commitment. So usually banks refrain from firm commitment unless and until your company is in a very good position. Okay. Next you have the best efforts. In best efforts, what banks say that, okay, we will try our best. Okay, you want $100 million. Okay, we will try our best. I will issue the bonds on your behalf. And we both will go to each of the clients. Okay, we both will go into the market. We'll say that, okay, this is the bond. You buy it. It's good. It's good. And if they buy, then it's okay. And whatever money you are able to raise it, you take it. I'll just charge certain commission. Okay, certain fee. Now here, the full liability is not on the bank. If let's say not all the securities are sold, then the losses are actually borne by the companies also who are issuing the bonds on, okay, through the investment bank. Next, we have the IPOs. So this was basically about the bonds and all. Okay, in fact, for equities also you have private placements. But what is IPO? That is initial public offering. So in this case, IPO occurs when a company wishes to issue shares which is initially not publicly traded. That means for the first time, if it is being made available for the public, then such kind of offering, share offering, is called IPO. Okay, and usually IPOs are made on the best efforts basis. Okay. Next, what is the post IPO share price? So if once the IPO is done, once the first batch of shares is issued for the public by a company, now you need to understand the difference. Okay, shares are issued time and again. So if I talk about let's say Mid Education, okay, that is Midafin. Let's say Midafin issues goes for an IPO. So the thing is, till this point we have not asked common public to invest in our company. Okay, it's some of the private investors, okay, who have invested money, and uh, we are doing the business. Okay, now the moment we plan to go public, since our shares are not already in the market for public offerings, or since our shares are not there in the stock exchange, so this will be an IPO. Now once the IPO has been issued, let's say I become listed. Okay, my shares start trading in the open market. Retail investors can buy and sell them at their mercy. Now after few years, I again wish to raise more capital. Okay, so this time also I'll be issuing new shares only. Okay, in return for money. Okay, but this is not considered an IPO. Okay, now in IPO things are slightly different. So what happens? First, you are asked to bid for the shares, like you need to buy certain lots. Okay, then maybe lottery is done or something is done, and based on that, shares are allocated to different investors. Okay, and this is all the primary market activity. This is what we call primary market. IPOs are primary market. Then what happens once these shares are allotted? Then the stock is listed on the shares are listed on the stock exchange. And the moment it gets listed on the stock exchange, okay, it starts trading in so basically stock exchange actually acts as a secondary market. Okay, where you can buy or sell the existing shares. Okay, so what happens usually that immediately after the IPO, there is a bounce or jump in the price of the stock. So initially, let's say in the IPO, initial public offering, let's say the stock price was 70 rupees, but when it got listed at, let's say, 120 or 130 rupees. This is the post IPO share price that we are talking about. Okay, and that's why IPOs are considered attractive by the investors, because here you have a chance of substantial gain over a very short period of time. Okay, so today you are allotted an IPO. Okay, for let's say Midhafen, and the share price is let's say 70. And on the day Midhafen is listed on the stock exchange, it shoots up to, it is listed at a price of let's say 130. So instantaneously over a period of 15-30 days only, you are able to gain somewhere around 60-70 rupees per share. And that's huge. Next, distribution of IPO. Bank offers IPO to their best customers and senior executives of large companies, which is called spinning. Okay, and this is a problem. This is what we call favoritism. Like, so I'm a very good client of a bank. Okay, I'm an institutional investor, or let's say I'm a big investor. I'm a very big my bank is a big fan of me. So whenever a new IPO will come, the bank calls me and says that, okay, there is a new offering. This is the price. Would you like to invest in that? Okay, so here what happens? A lot of other peoples uh, are not given this opportunity to exploit or to earn money out of this. Okay, so a way out from this IPO is Dutch auctions. In Dutch auctions, what's happened? Individuals and companies bid for the shares. Okay, and in the bid, they write down, in the bid letter, they write down the number of shares they are willing to purchase and the price at which they are willing to purchase. Okay, then what happens? Once the companies receive the lists, so they sort this on the based on the decreasing order of the share prices. So the highest price and the number of shares will be at the top, and so on. Okay, and let's say I had to issue 10,000 shares. Okay, then I'll see that, okay, the highest bidder wanted 1,000 shares. Second highest bidder wanted, let's say, 2,000 shares. Third highest bidder wanted 4,000 shares. Okay, and fourth highest bidder wanted, let's say, 2,000 shares. So we have exactly 10,000 reaching at 4,000. Okay, at the fourth bidder. And let's say fourth bidder quoted a price of $80. So I will start allotting shares from the top, and I have used up all my share when I come to the fourth investor. Now, fourth investor quoted a price of $80. Okay, that will become my issue price for the share. Okay, the lowest price at which a share is allotted, okay, becomes my issue price. And this is more transparent in the way that it leads to better price discovery and all. Okay, because in the case of private IPO, things are not clear. Like if let's say I am an institutional investors and I come to the bank, or let's say bank contacts me about an IPO and I say that, okay, I will buy it. I'm totally interested, but I'll pay this much. Okay, let's say I'll pay $50 per share for this stock, and I'll buy, let's say, 70% of the share. Okay, or 40% of the share. Then bank might be willing in this regard that, okay, all in one go, I'll be able to sell 40% of the share. So let's manipulate the company. Let's say them something so that they agree to sell it. But in case of Dutch auction, it's not possible. There are multiple bidders, and the bidders who is the bidders who is allotted the shares at the last, the price at which he placed the bid, that price becomes the share price. Okay, for that stock. Advantage, it includes market clearing price, okay, and avoids favoritism in distribution. Disadvantage, you lack the leveraging, you lack actually the leverage of investment bankers' relationship with other large investors, okay, which leads to slow selling process. So in case of internal IPOs, what can happen? Banks know that, okay, I have some big clients. If I can convince them, I'll sell it in like within few days. The shares will be issued. Okay, so there, the process is really quick. But in case of Dutch auctions, the process is not too quick. It can be time consuming selling process, thereby increasing the costs and all. And finally, it is also possible that you may not end up getting the desired price. Okay, sometimes. However, successful Dutch auctions have happened in the past. Google Alphabet Inc. is a classic example, okay, of Dutch auction. Now, another thing that banks actually involve themselves in are the advisory services. And in this, we have investment banks advising on mergers, acquisitions, divestments, and corporate restructurings. They do advising on that. They also advise on strategies to prevent debtor takeovers, So let's say I'm a company. Now I am worried, I'm a small company, I'm doing really good. Okay. I am worried that some of my competitors who have a lot of money might try to acquire me. Or so how do I avoid that? So for that, and if the company is acquired, then what about the rights of the existing shareholders or the existing employees? How can I safeguard them? So not sometimes just to avoid it, but in order to have safeguards during the time of mergers and acquisitions. So in that, they also advise that what you can do in order to be in a position where you have more bargaining power. If you face an acquisition or a merger. Okay, and these advice that the banks give are actually considered poison pills. That okay, if you want to buy my company, then you will have to do this and that. Okay, that's the regulation of the company. That is the policy of the company, my company. Okay. So what are the poison pills? So there are basically 6, 7. First is adding provisions to the charter that can trigger shareholders' right. Okay. In the event of takeover for selling the share at a premium. So I can keep a clause that, okay, if the company is took over by some other big company, then existing shareholders can sell their shares at a premium price. Okay. That means, let's say currently at the time of acquisition, the share price is 70. They will be able to sell it at the price of 80, thereby increasing the cost of acquisition. Okay. Second, granting stock options to key employees that vest upon takeover, potentially leading to an employee exodus. Okay. Sometimes what the banks want, what the companies want, that okay, I should not lose my top brass. Okay. So what they do, they give them options that okay, if the companies took over, then you have this option available with you. You can use it and you can buy the shares. Okay. Because usually this happens, like when the companies took over, existing employees are fired, and when they are fired, it can create problems for them. In order to safeguard them, I have given them options that if you're fired, you can exercise this option, you'll be able to get these many shares at this price. So that will give you a huge chunk of money. Okay. Second, implementing provisions in the charter to protect existing directors from removal after acquisition. Usually it happens once once you acquire a company, the existing director is removed from the company. Okay, so in order to keep that bargaining power, you can have you can add provisions, like for example, when WhatsApp was took over by the Meta, that now Meta, then it was Facebook. Okay, so WhatsApp had such structures in place, such provisions in place, which actually helped the founders of WhatsApp to stay in the board of directors of the new companies. Okay. Then issuing preference shares that convert to regular shares upon change of control. Okay, so for example, I have issued preference shares which can actually get changed if the control is shifted. If the company is acquired or took over by some other company, then it can be converted into regular shares. Okay, where they can sell it and exploit the market price. Then offering existing shareholders discounted shares during or after the takeover. So if let's say I am existing shareholder now, if the takeover is happening, so the price at which let's say at that point of time the stocks are traded in the market, so existing shareholders will be able to buy it at a lower price or sell it at a higher price. These things can be arranged for that. Okay. And finally, altering voting structures to give certain shares more votes. Okay, voting structures in the sense that we usually say that the majority, the person who holds the majority of the shares gets the maximum voting rights. Now, after the takeover, let's say I am the director and I lose a lot of rights, for example. Okay, so maybe I'll have only 10% of the shares left with me. So I need to, so the thing is, I would just give a clause there that if you're acquiring and if I end up with, let's say 10% of the votes, then my voting rights is 10% of the shares, then my voting right won't be considered 10%. It will be, let's say 25 or 26% or something like that. It will count 25 votes, 25% of the total votes will be my votes count. Okay. So that's the end of this lecture. So just give me a minute. Now I'll start the next chapter. Uh, yes. Is the screen visible to you? The new chapter, is it visible? Okay. So now we are going to cover FMP2, that is insurance companies and pension plans. Okay. Now in this chapter, our objective is to understand what is insurance. Okay. Different types of insurance, how in a basic way, how the insurance premiums are calculated. And if you're calculating the insurance premium, the most foundational thing is to understand the survival probability of the policyholder and the probability of death of a policyholder over a given period of time. So how these things are calculated, we'll see mortality tables that are usually issued by the government of a country, okay, which are used by banks to find out the insurance premiums that they should charge to their policy holders. And then we'll see pension plans, the different types of pension plans, defined contribution, defined benefit, and which is more actively used. Okay. Now let's start. So in this chapter, first let's have the introduction. So what are insurance? Basically, these are the protection against a specific adverse events, and for this protection, policyholders actually pay premium. Okay, and this premium payment is something that is decided by the insurance companies using certain mathematics. If we are talking about insurance related to life and health, then Mortality tables are taken into consideration by the insurance companies to find out what should be the premium. If it is something else, then the value of that. Let's say if it is a business insurance or something like that, then value of business, the risk that something will be lost. Okay, so these things are considered while finding out the premium. And in this chapter, our objective is to focus more on health, okay, and life insurance, whole life insurance, and term life insurance. We'll see how, in a basic way, how the insurance premiums are calculated. Okay. Now, the most insurance contracts can be categorized as life insurance, property and casualty insurance, where we have insuring our house against the theft or fire or things like that. Uh, uh, Car insurance, okay, bike insurance, all these things come under the purview of property and casualty. Then you have health insurance, okay, where we are insuring our health, that if something bad happens and I'm admitted to the hospital, the immediate cost is not, the cost is beared by the insurance companies. In the case of first two, in the case of life insurance and property and casualty insurance, probably on most of the cases, the insurance premium is fixed. It does not change. But in the case of health insurance, the premium is variable. Okay. It can vary from person to person. Next, you have employee sponsored pension plans where employee and the employer makes regular contributions for the in the pension. Okay. And this pension is actually used by the employee after the retirement. Okay. So let's understand first and foremost the basic thing, that is the mortality tables. Mortality tables are actually issued by governments, and it contains data on the probability of death within 1 year, the survival probability, and the life expectancy. Okay, for each age. So let's say you are of age 0. Okay, so in that case, you will have a probability of death almost very less, survival probability almost close to 1, and life expectancy almost equal to what your life is right now. Okay, now as your age increases, your probability of death will increase, your survival probability will decrease, and your life expectancy will also decrease, which is evident from this table. If you look, a person aged 30 has a probability of death of 0.1498%. Okay, and this is not Indian data, it is US data. Okay, it is something that we are talking from the perspective of US. And your survival probability is 97.52. That means the chance that you will live from the year 30, from the age 30 to 31 is how much? 97.52%. Okay, life expectancy, if you're 30 years of age, it is expected that you will live for the next 47.86 years. These are the basic definitions, okay, of the three terms that we are seeing here. And clearly, if you look at a person whose age is 73, their probability of death is 3.03%. Okay, it's almost 30 times, not 30, almost 20 times more than the chance of death for a person with age 30. Okay, your survival probability is 67.93% only, and your life expectancy at max is 12.36 years. That means you may only live for the next 12.36 years. Okay, and that's why you will see that if they are giving out insurance, okay, that means where they will have to pay out money for elderly people, the insurance premiums are usually higher compared to young people. Okay, but when it comes to on the liability side, like when it comes to making the payments, then elderly peoples are offer more benefits there. Okay, that okay, if this person invest in this kind of thing, then you will get this much amount, because, and for FDs also you will see senior citizens are given more benefit, because they know that maybe in some years they will die, and there will be a case that they will have to withdraw money, okay, before the FD matures or things like that. So that's the reason, one of the reasons that this is done. Now let's talk about mortality tables in detail. So if we talk about the probability of survival in year n plus 1, I am in year 0. Okay, my probability of survival is 1. I am 100% sure that first year will be survived. So what will be it? It is probability of survival in year n times the probability of not dying in the next year. Okay, then this is nothing but probability of dying, 1 minus probability of dying in the next year. Okay, probability of not dying in the next year. That gives us the probability of survival for year n plus 1. Okay, this is the basic formula that is used. So here, for example, let's say that the probability the man will survive until age 71 is given as probability of survival for year n, that is for survival for year 70. And here in the previous slide, for year 70, probability of survival is how much? 0.73427, and the same has been taken, 0.73427 times 1 minus the probability of dying, that is This is nothing but probability of not dying in the next year. That means probability of no death in the year 71. That is 1 minus 0.025549. Sorry, 23380 in the year 70. So that turns out 0.71710. This becomes my survival probability for age 71. Okay, for age 72, again, recursively, I can find it that, okay, survival probability of age 71 times 1 minus the death probability of age 71. Okay, that will give me the survival probability of age 72. Okay, and so on, we can do the calculation. Next. Let's see one more thing about the probability of death. So let's say I have a man who is aged 71 and I want to find the probability that he will die in the following year. So that is clearly from the table it is given that age 71 he will die in the following year is how much? 2.5549%. Okay, this is the age 71. Next, what I have is I want to find the probability that man aged 70 will die between the first and second year. Okay, will die between the first and second year. That means not at the age of 70, but between 71 and 70. So, but between the first and second year. So for that, I can utilize this formula. He has to survive the first year and then he will die in the second year. So death probability of second year times probability of not dying in the first year. So not dying at the age of 70 and dying during the age of 71. Okay, that is taken into consideration, and I find the conditional probability that, okay, it is 0.024952 or 2.4952% is the probability that a 70-year-old person will die between the first and second year, after 1 year, but before 2 years. Okay, will die after 1 year, but before 2 years. This is the probability of that happening. Okay, 2.49% is the chance, or I would say 2.50% if I approximate it. Okay. Next, let's see whole life insurance. So what is whole life insurance? It ensures the life of the policy holders. Here, you make the regular monthly or annual payments until you die. Okay, you are insuring your complete life. Now, face value of the policy is paid to the designated beneficiary upon death. Okay, so if I die, let's say I take up life insurance, whole life insurance. Okay, there is a difference between whole life and term life. Okay, and I'll tell you when you should take these things. Whole life insurance, let's say you take it, and in case of whole life, if I've taken the whole life insurance, so for the next, until I live, let's say I live for 70 years. So till the age of 70, I'll keep on paying the insurance premium. The benefit is the moment I start a whole life insurance, and let's say I die after 10 years, then also there will be a payment given to my to the beneficiary or to the nominee, which we call. Okay, and the amount given will be the face value of the policy. So if I had taken a whole life insurance worth 5 crores, for example, and if I die, let's say after 10 years, then my beneficiary, whoever I have named it, okay, whoever that person is, will receive the face value amount. That 5 crore rupees will be given to that person. Okay, now nowadays we have a different variation of this whole life insurance, where instead of having a provision to give the lump sum amount of 5 crores altogether, you can by distribute this 5 crore over multiple months, and every month that person will receive certain amount. If you feel like, okay, you're not confident enough on your family that if they get so much amount of money, all of a sudden they will do something rash and they will lose all the money. So in that case, you can have a fixed monthly plan that after you die, every month the bank will issue a check worth, let's say 4 lakh, 5 lakh, something like that. And for the next 20-30 years, the family will keep on receiving that money. Okay. However, that is something that we are not discussing. It's simply the face value lump sum is given. So let's take an example. Let's say a 30-year-old male plans to take a whole life policy where $1 million will be the face value. So if the male dies after a certain time after taking the life insurance, the beneficiary of this person will receive $1 million. Okay. So in this case, what I'll have to do first is, using the table 1, I'll see what is the probability of 30-year-old male dying in year 1. Okay. Within 1 year. Within 1 year. So that is actually evident from this table. If I go back, 30-year-old male, probability of death within 1 year. How much it is? It is 0.001498%, or I would say 0.1498%. This will be taken into consideration. Okay. And in this case, the expected payout. So using the probability of death, they will find out the expected payout. So what is the chance of death? 0.1498%. So what is their expected payout in this case? Probability times the face value, that is 1498. Okay. Similarly, for second year, the person has to survive the first year. This is the probability of the not dying in the year 1, and this is the probability of dying in the year 2. And then I need to find out the payout of the second year. So this probability, whole probability of dying in the second year will be multiplied with 1 million. So I find that expected payout is 1534. So what you see gradually is that as the age of the person increases, the expected payout keeps on increasing. Okay. And expected payout, that's why it is written here that the expected payout increases year by year. And from the table, you can find that the probability of age 30 will survive until 70. So let's say you are expecting that, okay, till what time I will keep on receiving the premium. Okay, life insurance premium. All these are expectations. Nobody knows. Maybe I take care, I issue the insurance student, tomorrow I meet up with an accident. Okay, I'm by the road eating some snacks and a car comes and do a hit and run on me. Okay, I'll die. But under normal circumstances, it is being said that they usually calculate this. Okay, I want to find out for how many years can I keep receiving. So for that, they take into consideration the life expectancy from now. So we saw that for a person aged 70, the life expectancy was 46. Sorry, for a person aged 30, the life expectancy was 46. So I can say roughly that the person will live till the age of 76 years. Correct? Because from now the life expectancy is 46. So they are not making a very wild guess. They are saying that, okay, what is the probability that the person will live till 70 years? It's reasonable to say. And for that, this formula can be used. That is probability of survival from birth until age 70, which is the survival probability, divided by the probability of survival from birth until the age of 30, which is the survival probability of 30. When I divide it, I find that, okay, there is a 75.29% chance that a person aged 30 will survive till the age of 70. Okay. And then the probability that the policy holder will die between the age 70 and 71 can be found. Okay. Using this model, this is something that we have already done. That is, a person aged 70 will die within the next 1 year. Is how much? Is 2.338. We have seen it in the previous table. And this is the probability that he will survive till the age of 70 from now, from the age of 30. So I find that the probability of the policy holder dying between the age of 70 and 71 turns out to be 17.604%. Okay, that's the conditional probability. Okay. So at this point of time, when the policy holder is 70, the expected payout is 17,604. And it clearly indicates that as the age is increasing, the expected payout is also increasing. So let's say they decide that the premium charge should be $15,000 per year. Okay. Now here, what you see is that for many years during the initial life of the insurance, they have an expected surplus. Okay, they have an expected surplus because they are charging a premium which is sufficiently higher than the expected payout for that year, which is 15,000. Okay, but after certain age, there is an expected deficit. Okay, that means let's say this is 60 years of age and I live till 60, I have been paying. Then after that, the premium that the expected payout for me should have been, let's say 17,000, 18,000, something like that, but I'm still paying 15,000 only. Okay. So until the age of 60, they have actually a surplus coming in from this insurance contract. After the age of 60 only, they have a cost. The insurance company have a expected cost. Okay, there is an expected cost and an expected deficit. And this is an ideal scenario. And you might wonder that, okay, all this mathematics will fail the moment a person dies. But you need to understand that it's not only one person to whom this policy is being sold. Okay, there are millions of people who will buy this. Okay, out of those million, the probability, the mortality tables that we have seen will work really well. Okay, maybe for a group of 1 people or 100 people, it may not work well, but for a group of millions of people, it will definitely work well. Okay, the law of large numbers and generalization, we all know things like that. Okay, everything converges to normal. So that's a different thing, but yeah, the thing is that this theory actually works. And here we have taken the example of only one person. In reality, loans, these insurance are issued to, policies are given to millions of people. Okay, so these mathematics do work and they are able to decide upon what should be the insurance premium charged in the case of whole life insurance. Okay, next, Whole life insurance can be divided into three categories: variable life insurance, universal life insurance, and variable universal life insurance. Okay, these are the three versions of the life insurance policies. Next, we will see the term life insurance. So term life insurance basically can be considered you see, whole life insurance is a way to safeguard your family in the event of your death. Like, you are the only earning member and you feel like, okay, if I die, nobody will be there to earn, my family will become poor. So what I do, I take a whole life insurance, right? In order to take that insurance, I'm paying premiums every year. Okay, but term life insurance are more of a risk management tool. In the case of term life insurance, you cover your life only for a fixed period of time. Okay, a specified number of years. If you die within that time period, you will get a payout. Your nominee or your beneficiary will get a payout equal to the face value of the insurance. Otherwise, there will be no payouts. And this is done usually when you have loans on your head. Okay, so let's say you have taken home loan, business loan, and total of your loan is somewhere around 2 to 3 crores. Now, if you die today, so who will pay out this loan? Let's say there will be earning members. Let's say your younger brother might start earning. Okay, might take a job. Your other family members might take upon some job. They will get a job in MNC or something like that. But this 3 crore loan, what will happen to it? Okay, it will be an unnecessary pressure upon them. So even if they have a job, they will not be able to keep up with the lifestyle, and they will not be able to meet up with their day-to-day needs properly. So in that case, you feel like, okay, I have these loans are for 10 years, right? So let's take a 10-year life insurance. Okay, this is called term life insurance, and the term is 10 years. In this case, what will happen? If within this time period I die, okay, I'll get a payout equal to, let's say my loan was 7 crores. I had taken a loan of, I took a life insurance cover of 8 crores. So if I die between this 10-year period, my family will receive 8 crore rupees. Using this 8 crores, they can pay out the debt that I had taken. That was 7 crores, and 1 crore will be still left to them. Okay, so that's how term insurance are helpful. So term insurance can be considered as a risk management tool. And always remember, if there is a insurance company personal calling you saying that you should buy a term insurance, it is really beneficial. Don't fall to that trap. Term insurance is not at all beneficial unless and until you are into managing some kind of risk. You have some existing obligations and you feel like if you die, that is a problem. That will create a problem. Okay, then only go for insurances. And whole life insurance, you can take it. Yeah, there are tax benefits also if I talk about India. And of course, it safeguards your family at all time. No matter when you die, you will receive the face value amount. Okay. Next, for term insurance also, how the premiums are calculated. So here, let's say we are calculating a 3-year term insurance contract, which is being offered to a woman who is aged 50. Okay, so this is the data of a woman aged 50 to 53, because this will be here, there will be one premium received, then here, then here. 3 premiums are going to be received, and payouts are possible to be the mid of the each years. That is mid of the year between 50 and 51, mid of the year between 51 and 52. That is the assumption while calculating that payout will be, the person will die in the mid of the year. Okay, mid of year 1, year 2, or year 3. So probability of death, survival probability, life expectancy, everything is given. 3-year term insurance. Okay, what is the probability of death in year 1? Pretty simple, directly taken from the table. Next, probability of death in year 2, it will be survival in year 1 and then dying in year 2. That is 1 minus 0.003189 times the death probability in next year. Okay, that is 0.003477. Then probability of death in year 3, that is this year. Okay, I can find like surviving year 1, year 2, and then dying in year 3. This is the probability of that happening, 0.003770. I have the probabilities. Next, what I do, I assume that death occurs mid-year. Okay, and the discount rate is 5% with annual compounding. Now, present value of the expected payout per dollar of face value will be as indicated in this table. Okay, so expected payout will be how much per dollar? The chance of my death, expected payout, we have seen it in the whole life insurance, how the expected payout is calculated. Dying in year 1 times the face value amount. Okay, I have the discount factor. I directly found the present value. Okay, this is my expected value per dollar. Okay, if the face value of the loan is $1, this is the expected payout in year 1. Okay, that is half year from now. So then I find what the present value, and present value is found and the total is taken. So my total expected payout in this term insurance contract is $0.009681. Okay, today, present value. Okay, next, if the premium paid by the policyholder is X and it is paid in advance, of course, if you take a premium, if you take a policy today, you will pay first installment today. Okay, and whatever it is, let's say it's 1,000, so I'll pay 1,000 today. Okay, then the next year. So one thing is sure, that today's premium will be received. I have 100% surety about it. Okay, but whether I'll receive the premium at the end of 1 year or at the end of second year, it actually depends on multiple factors. Okay, and it actually depends on the fact that I am alive for year 1, and the payment that they will receive in the third year actually depends on the fact that I'm alive for the complete year 2. Okay, because at the end of year 2, I'll be giving, or at the end of the year 2, which means the start of year 3, I'll be giving the third premium. Okay, so first premium, there is 100% certainty. Probability of first premium being paid is 100%. That is 1. Probability it will receive the second premium after 1 year if the policyholder is still alive. Okay, so for that, probability of survival for first year will be considered. So probability of second premium is 1 minus the chance of death in the first year. That is 0.996811. This is the probability that the insurance company will receive the second premium. And for third premium, this is the probability. Okay. Now I will find the present value of the expected premiums received by the insurance company. And these should actually equate one another. Okay, so here we have the expected value of premiums. First premium expected value exactly equal to X. Second, I take $1. Okay, this is the $1 um, premium received for $1 of face value times the discount factor. I get the second premium. Okay, then the third premium. This is my total premium. Okay, present value of total premium. So expected payout should actually balance the expected premium today. So I can say that the calculation that I did, that is 0.009681, which was the total of the last table, should equal to 2.850327x. And from here, I can say that for every $1 of face value, the premium should be equal to 0.00396. And depending on what was the face amount was 1 million. So I just multiply this number with 1 million, and I find that this lady, 50-year-old lady, should pay $3,396 per year in order to get a term insurance plan, term insurance of 1 year, of 3 years, with a face value of $1 million. Okay, and this calculation is actually important from the exam perspective. You see, there is nothing new that we are doing in this chapter. We have studied everything in the probability chapters. It's just the way in which things are being applied that you need to understand. Okay, and you will have 1 to 2 marks easily. Next, we have the annuity contracts. So life insurance companies, annuity contracts, these are issued by life insurance companies, and annuity contracts are basically lump sum amount is distributed into, is broken down into regular payments. Okay. And generally, life insurance companies offer annuity contracts plus the life insurance. You see, at the start, I gave an example that when I die, there is an option that instead of asking the insurance company to pay the lump sum, I can say that, okay, give them 5 lakhs every month. Okay, so that's what I'm doing. I'm converting it into an annuity contract. Initially, also, when I'm paying the premium, it's an annuity. I'm making regular payments every year. So it's an annuity contract for the life insurance company. Okay, annuity contract payments last for the rest of the life of the policyholder. Okay, when I'm making the insurance premiums, when I'm paying the insurance premium, for whatever time I leave, actually it acts as an annuity contract from the perspective of insurance company. So your insurance company, I am paying the premium. So what is happening? Every 6 months or every year, you're receiving certain amount from me. Okay, that's the benefit that you get. There are tax benefits also of purchasing an annuity, as I said, buying insurance premiums. Okay, the amount of policyholders fund growth is accumulation value. Okay, and then the longevity and mortality risk. These are the two risks that the insurance companies are exposed to. Longevity, that means person will live longer than expected. Mortality, that the person will die sooner than expected. Okay, major cause is a steady increase in life expectancy of people born, maybe because of increasing health, improved health infrastructure, more improvement of sciences. Because of that, we have, like, let's say, more medicines which can cure, let's say, those diseases which were earlier considered to be incurable. Okay, Mortality, major cause can be wars, epidemics, etc., where all of a sudden the death rate increases. Okay. Longevity is considered a risk for annuity business of the insurance company, because annuity business where they are paying out. Okay. So if let's say they have promised that, okay, you make payments for 10 years, then after that, until you die, we'll make certain payments. Okay. Endowment policies have certain structure like LIC in India. Okay. So they have a problem of longevity. If I live longer than expected, they will have to give out payouts for a longer period of time. Mortality is a risk on the insurance business on the receiving side. So when you are receiving premiums, and if they're, let's say I have bought an insurance contract and I die before completing all my insurance premiums, then at that point of time, insurance companies are exposed to mortality risk. Okay. Now, usually what happens, they do both the things. Okay. They have annuity payouts, they have annuity receipts. Okay. So usually they balance out one another, but not perfectly. So some exposure is still left, which has to be managed separately. Okay. One way to manage it is using the longevity derivatives, which have a payoff function like this. Not at all important from the exam perspective. Okay. Next, investments. Life insurance policies, annuity contracts, whatever you have, these are fund. They invest in funds. Okay. Like mutual funds, hedge funds, or mutual funds, or something like that, or maybe they will buy bonds, kind of these things. They will invest in these things. Okay. Most investments, not mutual funds, I would say. Mutual funds are for people like us. They don't invest in that. Okay. They have other kinds of funds like pension funds or something in which they will invest money. Okay. Most investments long term are long term corporate bonds, and some are only a small amount of money is invested in equity, and they try to match investment maturities with their obligation maturities. So if they have, let's say, they have created a portfolio of insurance contracts where almost all the insurances are maturing, are 30-year insurance. Okay. So they will usually want that, okay, I'm investing in a 30-year corporate bond. Okay. That's the thing. Risk on the asset side, market and credit risk, because they are investing in corporate bonds where you have market as well as credit risk. And on the liability side, where you have the insurance contracts that you have sold, you have the longevity and mortality risk. So there are multiple risks that they have to manage. Okay. In addition to these, they are also subject to operational risks as well. Okay. Next, what we have are the pension plans, which actually produce income for the remainder of the life after retirement. Okay. There are two types of pension plan. So one is contributions, how the contributions are made. First, contributions are deductible in taxation and contributions are made by employee and the employer during the employment period. So if I am employed till 60, so a part of my salary, I'll put it in the pension fund, and the same amount will be put in by the employer in the pension fund. Okay. Then pension plans, how do they invest? Most of the investments are in equities and can make obligations if equity markets do well. Okay. If they perform poorly, then pension plans may not deliver as expected. Okay. Prolonged decline in equity plus an increased life expectancy leads to huge deficits. That means, first of all, the fund is performing poorly. Fund is performed poorly, and second, the retiree, let's say, does not die. Okay. So pension fund will have to, like, the pension will have to go to the retiree. Okay. So the deficit keeps on increasing, and in the past days, the structure was that these deficits were covered by the companies. Okay. Companies used to cover up the deficit. That means it was like, okay, you are taking the future generation's money and using it to give to someone who is from the past. Okay. So you are actually using a future's money. Okay. Future generation's money. There are two types of pension plan. First is defined contribution. Second is defined benefit. Defined benefit plans are now not that much used. Defined contribution is used nowadays by the companies, where the contributions of the employer and employees are defined. The fund in which invested can be designed, but not the benefit is defined. Benefit is not defined. In benefit, if the benefit is defined, then it means an obligation that, okay, after the retirement, this is the amount they have to receive. They have to receive. But if in this case the fund performs poorly and the life expectancy of the person is long, then there will be huge deficits. Okay. In defined benefit. And nowadays you will not find defined benefit plans. You will find defined contribution plans. Okay. Then you have property and casualty insurance. Property insurance, basically protection against damage to property from loss generating events, fire, flood, any natural disaster, anything. Okay. It can be anything. Now, casualty insurance cover liabilities due to injuries and damage sustained by others. So let's say you're driving a car and you hit a person. Okay. So by mistake, if it happens, nobody should do it intentionally. So let's say it happens by mistake. So casualty insurance actually helps you to cover the expenses, cover the losses that you will incur when you, if let's say you have to do the all the bandaging and all. Okay. So casualty insurance, as I said, actually covers the damages that you by mistake uh, do to others. Okay. So casualty. So let's say you're driving car. So you met with an accident. Let's say the other person is injured. So you'll have to meet up with the expenses of that injured person's recovery. Okay. So all these things are covered by casualty insurance. Okay. Next, what we have are property and casualty insurance contracts are basically renewed from year to year. That means in this case, the premium is not fixed. Okay, so if let's say this year you paid a premium of $3,000, next year, depending on your assessment, new assessment, the insurance premium can change. Okay, depending on how the insurance company perceive you. So let's say over the last 1 year, you never met with an accident. Okay, so maybe your property and casualty, or let's say your house, there was nothing that had happened. Okay, you have proper things in place and no theft, no kind of theft happened. Okay, so you renew the contract insurance, you need to you renew the property insurance or casualty insurance, then it is possible that you may get favorable terms. Maybe only $3,000 you'll have to pay. But as the time passes, and let's say in some years your house faces 2 to 3 thefts. Okay, or let's say over next 2 3 years, last 2 3 years, you have been continuously facing thefts. Okay, so in that case, the insurance premiums will be higher for you. Or in other cases, for example, in casualty, let's say you have been continuously meeting up with an accident. So then in that case, your casualty insurance premium will be higher for you. Okay. Now, the risks to property and casualty insurance company can be divided into following categories. First is risk where the average payout arises from independent claims. Independent claims means there is nothing abnormal happening. You are doing the day-to-day business, and chances that somebody will meet it with an accident, chances that a house will catch a fire. These are the things. So these things can be predicted really well from the historical data. You look at history that, okay, how frequently in a region you have fire incidents, how frequently you have robbery incidents. Okay, what is the overall improvement in the status on that region, and based on that you can devise that, okay, whether should I charge more or less, okay, for this insurance premium. But then you have catastrophic risk where the claims are not independent but they are dependent. Let's say all of a sudden you have a hurricane. Okay, now in this hurricane you have taken the let's say property insurance. So let's say your house is blown out. Okay, you have a cyclone, your house is blown out. So in that case, only not your house is blown out. There will be multiple people who have taken the insurance and their houses have blown out. So in that case, what will happen? Uh, these things cannot be predicted based on historical data. Okay, and here they have all of a sudden abnormal payouts happening. Okay, which they could not have predicted. So how do they manage it? Of course, they manage it using cat bonds, that is catastrophic bonds that are issued. Okay. Now, there are certain loss ratios that are considered when we are talking about the property and casualty insurance. First is the loss ratio. Second is the expense. Third is combined ratio after dividends, and operating ratio. Okay, so these are the ratios that are actually considered while calculating the property and casualty insurance premiums. Okay, because these are the costs that they on an expected basis they need to cover from the insurance premiums. Okay. So with this, we have completed the second chapter. Okay, so now let's have a short break of 10 minutes and then we'll begin with the third chapter. Okay. Yeah. So now we're going to start with FMP 5, that is exchange and OTC markets. Okay, now this is a theory chapter. And again, this chapter and the next chapter, that is FMP 6. These two chapters combined, you can easily score 2 to 3 marks. Okay, 2 to 3 questions will be there. And the chapters are not too much difficult. Okay, and questions are asked in the examination from these chapters. So if you can just understand the basic idea, the basic premise of what is happening, what all things are there in this in these chapters, you'll be able to easily score those marks. Okay. So here in this discussion, we are going to cover the important aspects of both the chapters, FMP 5 and FMP 6, in subsequent, like in the subsequent discussions. Okay. So first, we'll start with exchange and OTC markets. We'll understand the basics of what is exchange market, what is OTC market, what are their basic functioning, the ways to manage the risk and things like that. Okay. So let's start our discussion. First, exchange. Exchange, if I talk about, is basically an organization where members who trade, which have members who trade with one another. Okay, so if you have an exchange, let's say NSE, National Stock Exchange of India, NSEI. So here you have certain members who are the members of this exchange now, and these members can trade among themselves, with exchange being the central counterparty. Okay, exchange is at the center. Every trade passes through the exchange with another to the another party. No two parties do trades bilaterally. Okay. Next, if we talk about early exchanges, then first it was basically considered only a forum for trades. Okay, where people would come and there was an open outcry system. They would cry out what is happening, and you can just book the trades from there. And that was the basically the function of exchange, a place where traders can meet and do the transactions, be it buying or selling. Then another feature of these early exchanges were expulsion of defaulting members. So if let's say there were 100 members and out of them, let's say 2-3 members defaulted. Let's say some of the members said that, okay, I'll buy the stock. And when the time actually came for buying the transaction, they were not able to deliver it. So these members were usually expelled from the market. Okay. These members were usually expelled from the market. Then third, standard contracts were there and dispute resolution was done. Disputes were resolved between the members. Look, so there was a committee who would look into the disputes that is happening, that maybe price dispute or whatever. Okay, obligation dispute, and that was resolved. And then standard contracts were available, like, okay, if you are trading here, you have to fulfill this and this criteria. These kind of assets can't be traded. If you're trading this, you have to do transaction within these many days. So basically standardization, all the terms and conditions were defined properly. Then you had no mechanics for loss protection. As I said, like here, it was one of the feature that they would expel the defaulting members. Okay, so that's the only thing that they used to do. Okay, so if a member has defaulted, they had no way, the exchange had no way to ensure that the person who is at the loss will get something. So there was no loss protection of any kind. And that led to the early developments in exchanges. Okay, since there was no mechanics for loss protections, so that led to multiple developments that happened in the market. And first was introduction of initial margin for counterparty protection. Okay, so whenever a trade was booked, so usually an initial margin was put in place so that if the trade is not executed, then at least the losing party will get the initial margin amount. Okay, then development of netting arrangements. Transactions were started to netting. Okay, the exchange started to net the transactions so that net exposure of a person can be seen, and accordingly things can be done. Okay, and we will understand these margin and netting in detail in the upcoming slides, so don't worry. Now, what is margin? So in margin, what happens? Asset is transferred from one trader to another for protection against counterparty default. Usually this asset is in the form of cash or cash equivalent, okay, which are highly liquid. So here we take an example to understand it better. So for example, let's say we have a trader A that has agreed to buy corn from trader B in June. It's a future transaction. Let's say it's May, for example. Okay, so here, what are the things possible? So trade agreement happens at that price of at that point of time. The corn price is $400. 400. Okay, per bushel, per 10,000 bushels. Next, what happens? Corn price declines by 5 cents and it becomes 395. So in this case, there will be a margin transfer. Okay, what will be the margin transfer from A to B? Because A has agreed to buy and B has agreed to sell, and the agreed upon price was 395. Now the price, when it decreases, the agreed upon price is 400. Now when the price decreases to 395, trader A might get inclined towards not honoring this contract, because now that trader A might feel that, okay, I'll be able to buy it at 395 only. But that's not going to happen, because now the trader A had already agreed to 400. Okay, so in this case, what will happen? There will be a margin call. The exchange will say that, okay, trader A, you give me $500. Okay, because that $500 is at risk. So if on this day trader A decides to dishonor the contract, so what will happen? Trader A will lose $500. Trader B will get $500. Okay, and the thing is, after this transfer of margin, even if the trader A declines to honor the transaction, trader B can sell it at 395, and the effective price that he end up earning is actually 400 only per bushel. Okay, 400 per bushel. This is the transaction. This is the transfer for 10,000 bushel, not one bushel. Okay. Next, corn price, let's say, further declines to 385. Then again, there will be a margin transfer from A to B worth $1,000. Okay. Then finally, if let's say it increases to by $20 after some time, price becomes 405. Then there will be a net margin transfer from B to A. Because in this scenario, B will feel like, okay, I have agreed to sell at 400. Now today the price is 405. So let's ignore trader A and sell it at 405. Okay. So just to safeguard from these scenarios, there will be a margin transfer from B to A in this case. Okay. Now, let's understand netting. So what is netting? This was margin. In case of netting, what happens? Short and long positions in a particular contract are offset basically. Okay. So for example, I am a trader, and let's say you guys are a trader. Okay. So what I do, I enter into 3 different types of contracts. In some contracts, I am long, in some contracts, you are short. Okay. So netting means that I will find the net position. That, okay, I am long in 3 contracts. I have to pay, let's say, $10,000. And I am short in, I'll receive, I have to pay $3,000. And I am short in subcontracts, I'll be receiving $8,000. So what is the net of this? $10,000 receiving, paying, and $8,000 receiving. So the net position for me is that I will pay you guys $2,000. That's netting. Okay. So that helps us to reduce exposures to an extent. Here the example has been shown. Okay. So simply the present value of $2,000 is transacted now. For example, A and B are there. $40,000 A will pay to B, and 10,000 bushels B will give to A. Okay, of corn. And let's say there is another transaction in which what is happening, B will give to A $38,000, and A will give to B 10,000 bushels of corn. So here you will find the net of transaction, $40,000 from A to B and $38,000 from B to A. So net is $2,000. And if I have to net it today, you find the present value of $2,000 that will be netted. Okay, net of $2,000 from A to B. This is a simple netting. Then you can have a netting where you have more than 2 parties. So let's say you have A and B, where these kind of transactions are there, and B and C, where B will pay $40,000 and get 10,000 bushels of corn. Now here what we can do, we can safely eliminate B by netting the transaction between A and C, because here A is exposed to the credit. Here 2 parties are actually affected due to B. Okay. And in fact, if something wrong happens to C, A is affected. If something wrong happens to A, C is also affected. If something wrong happens to B, again A and C are both affected. So that's why a netting arrangement is arrived at between A and C, where the transaction will be $40,000 will directly go to C, and C will directly give 10,000 bushels of corn to A. This is second type of netting where you have 3 parties involved. Okay. And next we are going to understand central counterparties. Now, central counterparties, especially in today's market, if you'll see, there are central counterparties which act as the central party which takes opposing position to with each of the members. Okay, and they are the one who will clear all the transaction among the members. Okay. So here, if I take a bilateral netting arrangement, what was the scenario? That, okay, A will give to B certain amount and B will give to A the bushels. In the case of central counterparty arrangement, we will introduce a third party in between. It's kind of like a structure that we saw here. Okay, this is structure A, B, and C. Okay, so here you can say that in a way B is a central counterparty. And when this is done, the whole risk is assumed by the CCP, central counterparty. Even if the A defaults, B has nothing to worry about. C will have to honor the obligation. Even if the B defaults, A has nothing to worry about. The CCP will honor the obligations, no matter what happens. Okay, so that's the one way to reduce the risk exposures of the transacting parties. Okay, and this is a very basic structure where we have only 2 counterparties, but in reality we have multiple parties that members that actually facilitate their trade through central counterparty. So here what is happening? Initially, A had to give B $20,000, and B will give A 5,000 bushels. Okay. Now, when the CCP is in place, A will give CCP, not B, $20,000, and CCP will give A 5,000 bushels of corn. Okay. So A takes whatever position has to be taken, A takes with the CCP, and the opposite position is taken by the CCP with B, where B will receive $20,000 from the CCP, and B will give 5,000 bushels of the corn. So if you see, under normal circumstances, then CCP is at 0 risk. What is happening? CCP is taking money from A and giving it to B, and taking corn from B and giving it to A. Okay, it's just that he's assuming all the risk. That, okay, don't worry. If B defaults, A has nothing to worry. If A defaults, B has nothing to worry. I will find a solution. Okay. That brings in more confidence in the among the investors. Okay, and investors lose less money. Now, what are the advantages of CCP? First, central clearing house acts as the counterparty for all transactions. Any transaction that happens passes through them, so there is complete transparency about the trades that are happening. Second, member A can easily close out position with any other member on the exchange. So if let's say A does not want to keep this position open, he can close out his position. The only thing that CCP will then have to do is to find another party, let's say C, with whom he can take these trades and net the position out. Okay, the objective of CCP is to keep the position netted at all times. That's their main objective for the CCPs. Next, what we have is handling credit risk. So the moment CCP enters into this transaction, they are now exposed to credit risk. And in this case, especially the credit risk arises from both the sides, even if A defaults or B defaults, CCP will be at risk. So how do they manage it? So for that, they have certain structure. First, the first line of defense for them is netting. Okay, where they net the transactions between A and B, all of them, and they find out, okay, what is the net position. So A will give me 5,000 and I'll give B 5,000. B will give me 2,000 bushels of corn, I'll give a 2,000 bushels of corn. That is the net of the position. Okay, after that, they also, second line of defense is variation margin and daily settlement. They say that, okay, every day as the prices are changing, you need to make certain margin payments. Okay, so if let's say favorable prices are for B, then it is naturally the unfavorable price for A. So A will make certain margin payments to central counterparty, which will be given to the party B, member B. Okay, then there is third line of defense, which is initial margin, which is some amount of money which is kept with this CCP kept with themselves. Okay, keep with themselves. And these contributions are done by the members, okay, A and B. They say that, okay, 10% of the initial transaction money you'll have to deposit with me. Okay, that again acts as a safeguard. And then finally, they have the default fund contributions, which has two parts: fund contributions of the members of the transaction defaulting member, and then fund contribution of remaining members. So first, what they use is the fund contribution of defaulting members. Even if that is not sufficient to cover up the losses in the case of default of, let's say, counterparty A, then they will use the fund contributions of other members. And if still some loss is left to cover, then only the central counterparty will have to give money from its pocket. So there are 3, 4, 5 layers, 4 layers, in fact, that has to be crossed in order to reach, in order to CCP to feel the heat of the risk. Okay, and this is necessary because these central counterparties are not small entities. Okay, they are huge. They deal in transactions which can have notionals in trillions of dollars. Okay, and that to not 1 or 2 trillion, maybe 10, 20 trillions of dollars of transactions these parties are handling. So they need to have a very robust risk mitigation structure. Okay, and these 4-layer protection actually helps them in doing so. And usually by if I'll give you an example, like when the Lemon's brother went bankrupt, they had a lot of open positions in the bilateral market, and since a lot in the OTC market, and since a lot of them were through central counterparties, so what happened, these central counterparties were able to close out the position without affecting their equity. In fact, the thing was, the losses were covered using the initial margin only. Okay, due to the default of Lehman Brothers, all the losses were covered with the help of initial margin only, and some initial margin was left even after covering up the losses. So they were so quick to close out the positions. Okay, and the rest of initial margin was given back to Lehman Brothers. That, okay, you had, let's say, given me $2 billion as initial margin. We used only $1.2 billion. You see, $800 million is left. Keep it. Okay, I was able to close out your position. So that's how strong the structure of CCP is when it comes to managing their risks. Okay. Now, how do they handle? First, let's understand each one of them: variation margin and daily settlement. So a futures contract, for example, is settled day by day during the time to maturity. Okay, so until the maturity is reached, it is settled on a daily basis. Okay, so as the futures price fluctuate every day, whatever the change is, that differential amount is transferred between the parties depending on what kind of change it is. Okay, and whom it is favorable to. So here, if let's say I have a futures, if the futures price increase at the closing day, so what will happen? Exchange members that are net short will give money to the CCP, will give variation margin to the CCP, and CCP will in turn deposit this money into the exchange members that are net long. Okay, because we know that when the futures price increase, long position holders benefit, short position holders lose. Okay. On the other hand, if the future price increase at the sorry, just a minute. Here it should be decrease actually. Okay, it's wrongly written. If the futures price decrease, it should be. If the futures price decrease, then it's a good news. It's a bad news for long, short news for short. The good news for short. So what will happen at the end of the day, whatever the difference is, whatever the decline is, that amount is deducted from the accounts of long position holders and deposited in the accounts of short position holders. This is how transactions are done through variation margin. So what happens on a daily basis, whatever the risk is being adjusted. Okay, so that's how they are able to reduce the risk. So if let's say daily settlement is not being done, and by the time maturity comes, there is huge difference in the price. So CCP will make a margin call. Let's say, okay, CCP will ask the long position holders that, okay, give me the money now. And long position holders find it difficult because the difference is too large. They don't have that much liquidity now left with. Okay, so in that case, there will be more risk. So it is better that whatever the risk is, when it is small, we will cover it at that point of time only. We will not wait for the risk to become large. Okay, so whenever it happens, although it's more time consuming, but whenever it happens, more tedious, I would say, than the simpler structure, but it helps us reduce risk to a larger extent. Okay, the number of long position, CCP ensures that this happens all the time. That number of long positions always equals the number of short positions. Okay, so the moment a long position is closed, CCP will immediately start to find a counterparty to fill up that gap. Okay, and most of the time they are able to do it. Most of the time, in fact, on almost all the occasions, I would say, not all, almost all the occasions, they are able to do it. Now, daily settlement makes closing out future prices contracts much simpler. So if you have to close out, let's say you are initially long. So if you have to close out, what you will do because of daily settlement, you take the short position. Okay, on the same contract, your position is closed out. Okay, that's how you do it. It's really simple. Now, next way of handling is the initial margin. So how do they use initial margin? So in addition to variation, they have initial margin requirements as well. Okay, in this case, what they do, they say that, okay, you want to open a long futures position. So you do one thing. 10% of the stock price is how much? Let's say $1,000. So you give me $1,000 as deposit right now. Okay, this is something that you cannot take out. It will stay with me till the contract matures. Okay, as a security purpose. So if at any point of time you will default or you dishonor the obligation, I'll use this money to cover up the loss. Okay, and if anything is left, I'll give you back. No worries. Okay, but if nothing is left, then it's your loss. Okay. So in addition to variation margin, there is an initial margin requirement as well. And these can be in the form of either cash or marketable securities. Okay, marketable securities like some commercial papers, highly rated commercial papers, government bills, okay, things like that. Now, let's say there is a member who is long in 20 futures contract. So there are two scenarios. Without initial margin, what is the scenario? Let's say the variation margin payment is $10,000. Okay, fails to pay. And let's say what happens, this variation margin call happens, and the member who was long in 20 futures contract, he fails to pay. So in this case, CCP will close out the member's position immediately. Okay, and let's say during the closeout, what happens? Prices fall further by the time. So what will be their loss? $8,000. Okay, it has fallen further, and there was no initial margin. So the loss is $8,000. Now with initial margin, let's say what happens, where initial margin is set as, let's say, $700 per contract. So in this case, total margin is $14,000. Okay, total initial margin. So $14,000 is kept as a security deposit. Okay. Now, initial margin act as buffer to cover up the losses. Now, in this case, if let's say there is a loss, what will happen? Close out the position, loss of 8,000. Now, from where this CCP will bring 8,000? From this margin account. 14,000, they will use it. They will use 8,000. Okay, no loss is taken upon by the CCP themselves. Okay, and then $6,000 is left. What they will do? They will return it back to the defaulting member. That, okay, you see, you failed the obligation. Okay, 8,000 was the loss to cover up, to close out your position and initiate a new one. During this time, I lost 8,000. I cut it from your initial margin account. Now keep your $6,000. Okay, and go away. So what has happened? Because of this, loss has been prevented in its entirety. Now, what are the features of initial margin? First, it is set by the exchange. It reflects the volatility of future price. So for example, if the future price is less volatile, let's say the prices are comparatively stable, so they know that there won't be any large fluctuations in the futures price. So what they will do in this case, CCPs may be willing to accept even lower initial margin. So they will set the initial margin lower. But if this futures price is more volatile, they will set the initial margin a little bit higher. Then CCP actually pays interest on the initial margin. So what is happening here is that you are fixing your money somewhere. Okay, you could have used that money to do some kind of business or something like that, and CCP has now taken it as security. So CCP, what they do, only the initial margin money, not the variation margin. Okay, only the initial margin money they invest in highly rated securities. Okay, CCPs invest this initial margin money in highly rated liquid securities because they need it. They can need it at any point of time. So they need sufficient liquidity also, that they would be able to encash it without any significant loss in the value. Okay, so they invest it, and whatever the interest is earned, they pay interest. Some interest is paid to the margin account holder, and then a little bit, a small portion CCP keep with themselves also as their own earnings. Okay, then initial margin can be in the form of cash or cash equivalent. If it is cash equivalent, then there is a haircut usually. Now, what is haircut? It's not like the normal haircut that we get. Okay, this haircut means that, okay, let's say there is a security which is currently valued at 100. Okay, and if you keep the security, the CCP will try to assess its liquidity scenario and other factors also, like risk and all, everything. And based on that, they find that at the time of crisis, if I try to sell it, I may not be able to sell it at 100. So I'll reduce its value. So although its face value is 100, in the current marketable value is 100, but I will not consider it being valued at 100. I will say that, okay, it is valued at 90. So I have reduced this 10% price. This 10% reduction in the price is called haircut. Okay. And during the time of crisis, if you remember, this haircut went as high as 55%. Now, for high rated securities, these haircut is somewhere around 0.5 to 2% at max, not more than that. But yeah, it can go sometimes. Now, exchange actually have rules that reduce initial margin requirements for multiple contract positions, okay, by a single member. So let's say you are a member, now you are entering into 10, 12 different contracts. Okay, so your initial margin requirement will be like, for separate, each of them you will have to put in separately. So what they do, exchange say that, okay, you don't worry, I will find, so you are into so many positions, okay, so I'll find some common ground. I'll reduce the initial margin requirement to an extent. Of course, it is not done randomly. It is not done on a person-to-person basis. It is done based on some assumptions, some theories that back them up, some models that back these calculations. Okay. Now, next is default fund contributions. So as a safety net, final safety net, CCPs have default fund contributions where they say that, okay, I have created a fund. So you see, for a CCP, there are multiple members. For the sake of convenience, let's say there are 10 members. So what this CCP will do, they will ask all the 10 members that, okay, each of you make certain contributions. Okay, you are a member of the CCP. Okay, you have to make certain contributions. Let's say, depending on the size, there are multiple factors to decide contribution, but let's say all are similar. Okay, all the members are similar in nature. Okay, similar in characteristics. So the CCP says that, okay, each one of you have to make a $10,000 of contribution. Okay, and this is something that we will not use. Okay, it will be kept, it will be invested. If everything will just keep it. Okay, now if anything bad happens and if something bad starts to happening to me, then only I'll use this fund. So what it means actually is that if, let's say, one of the members default, okay, it basically acts as a deterrent also. I'll tell you how. So if, let's say, one of the member A defaults. Okay, now the challenge for CCP is to close out the position and create fresh positions so that he has a net zero exposure. Okay. In this case, you might say that CCP will ask other members naturally that, okay, you take this position or you take this position. Now these members will say, why will I take this position? This is a gone case. I have no exposure like this. I can't do this business. Okay, I'll not take this position. So CCP will be at risk. Now, if default fund contribution is in place, now they will feel that, okay, if the losses start to culminate, then what will happen? CCP will use our default fund contributions, the contribution that I have made also. Okay, and then he will ask for more money. So let's do one thing. If not I, then let's find any way so that we can close out this position. That actually speeds up the closeout position. So default fund contribution actually helps in two ways. First, it helps to mutualize the loss and it helps CCP to stay intact. And second, it speeds up the process of closing out of the default positions. Okay, so that's how default fund contributions help a lot. So in case of member default, let's say initial margin is insufficient. This is the default waterfall that I'm showing you. Member defaults, initial margin will be used. Okay, let's say initial margin is found insufficient. Default fund contribution of the defaulting member first will be used. So I had 10 members, right? And I said each member needs to contribute $10,000. So first I will use $10,000 of the defaulting member. Let's say member A had defaulted. I will use only $10,000 first. Okay. And try to cover up the losses. If let's say still the losses are not covered, okay, still insufficient, then I will use the remaining $90,000 to cover the loss. Okay. That's the loss waterfall that you are seeing. Okay. And if it is still insufficient, the default fund contributions are also insufficient, then only CCP will have to use their own capital. Okay. However, these events are very rare and I don't think that it has happened. Okay. That CCP's equity has been wiped out. Now, let's understand the use of margin accounts in other situations. There are multiple situations in which margin accounts can be used. Okay. So first, for retail traders. So the scenarios that we were discussing till now was the margin account structure between the exchange and the member. Okay. We are not the members. If I have to trade, I'll go find a member of exchange. Okay. And I'll say that, okay, help me buy this stock. On my behalf, that member will go to the exchange and say that, okay, I need to buy this stock. The exchange will then find a person who owns this stock, buy it from him and give it to me, and then I'll get it. Okay, so that's the structure. Now here, if you see the margining structure, there are two ways in which margin account. One margin account exists between the exchange and the member. And then one margin account will exist between member and the trader, retail trader. Okay, this is the most basic structure that I have explained. One more elaborate structure that also exists in real market is you have the CCP and the member. Okay, then you have the member and the broker, and then you have broker and the retail trader. Okay, and every pair, between every pair there will be a margin account, and the function of margin account is slightly different. And let's see what is the scenario here. So here you are a retail trader, so you will create a margin account with your broker. Okay, broker will create a margin account with the member, and then member will have a margin account with the CCP. This is how the structure looks like in reality. Till now, what we were discussing was this margin account between member and CCP. This structure does not apply to us. Okay, it will not apply to us. For us, margin account is slightly different. We have initial margin, we have maintenance margin also. In case of margin account between member and CCP, there is no maintenance margin. Okay, but between trader and broker, there is a maintenance margin. Okay. So here you have initial margin and the maintenance margin, and usually maintenance margin is set at 75% of the initial margin. So let's say you initiate a trade, derivative trade, and initial margin requirement is $1,000. So in this case, your maintenance margin will be $750, 75% of initial margin. Now the criteria says if your initial margin account balance or your margin account balance falls below 750, you will have to bring it back to the initial margin level. Okay, and if I assume that initial margin is always calculated on the initial stock price, initial price of the variable, okay, initial value of the variable, not the dynamic value. Okay, so let's say today if the initial margin requirement is 1,000, after 10 days also it will be 1,000. Let's say over this period my bank account balance decreases to my margin account balance decreases to $600. So in this case I'll have to deposit $400. Okay, and bring back my margin account balance back to $1,000 level or initial margin level. Now usually what happens in practice, initial margins change depending on the current market price. The initial margin will change. Okay, it's not fixed. Okay, however, when we study in theory, we say that, okay, initial margin is 10% of a stock price when the contract was initiated, and it will stay the same 10% of a stock price when this contract was initiated. But in practice, it is 10% of the stock price today. Okay, so after 10 days, if let's say the stock price is 1,200, you will have an initial margin requirement of, let's say, $1,200. Okay, and in that case, you will have to bring back your account balance to 1,200, not 1,000. Okay, and similarly, as your initial margin account balance is changing, initial margin is changing, your maintenance margin will also keep on changing. Okay, so you'll have to keep that. It is settled daily, PL added or subtracted. Okay, these things happen. And balance above initial margin can be withdrawn. If let's say you had an initial margin of $1,000 and after some days you see that your margin account balance is $1,500. Okay, and you see that your initial margin is still 1,000. So you can withdraw $500 from the margin account balance. You cannot withdraw all the money all the time. Okay. Next, additional margin if balance below the initial margin. Okay, additional margin, you need to add margin if it goes below. Actually, it should be maintenance margin. If it goes below maintenance margin, there will be a margin call. Okay, till the time you have a balance which is greater than or equal to 75% of initial margin, there will be no margin call. But the moment it becomes below that, it goes below that, you will have to deposit money in your margin account balance, and that too not only the differential of maintenance margin, you'll have to bring it back to the initial margin level. Okay. Margin not added, account will be closed instantaneously. Okay. Next, between broker and member, there is only initial margin. Okay. Between member and CCP, again, only initial margin. Okay. Variation margin is for all of them. Like, as I said, settle daily, PL added or subtracted. So on a daily basis, transfer is happening. So CCP gives variation margin to member, member gives variation margin to broker, broker gives variation margin to trader. Okay. That's how things happen. Now, let's see how we can use option accounts, margin accounts for trading in options. So option positions, there are two types, long position, and in long position, we have no future liability. So no margin is needed. We have paid the premium, end of the story. It is my wish now if I exercise or not exercise. Okay. For short position, it's obligation because they have sold the they have sold the option, they have received the premium, and they are under obligation to fulfill the contract. Okay. So here there is a margin requirement, and how the margin is calculated. So be it short or call, be it short call or short put position. Okay. These two calculations are done, and these calculations are based on CBOE, Chicago Board of Options Exchange, CBOE. Okay. 100% of the option value plus 20% of the stock value minus the amount by which the option is out of the money. OTM means out of the money. Okay. And second calculation done is 100% of the option value plus 10% of stock value. Whichever of these two is greater will be considered as your margin account balance. Okay. Now, based on this, you will have two types of questions asked in the examination, and candidates sometimes get confused when the questions are asked on margin account balance of or margin account of short call or short put. Okay. And let me tell you, in one type of question, they will ask what should be the margin account balance. Okay. So in that case, this is the formula: 100% of option value plus 20% of stock value minus the OTM amount, or 100% of option value plus 10% of stock value, maximum of these two. Whichever is greater will be my margin account balance. Sometimes they also ask what is the amount that the short position holder should add into the margin account. Okay. So in that case, this is not your answer. Okay. Your answer is slightly different. Why? Because you see, there are two parts. Okay, 100% of the option value, and then this is the second part, starting from 20% of stock value minus OTM amount. So 100% of the option value is the money that you receive. So you are not paying it. Long position holder has paid you. The moment you take short option position, your account is credited with the option amount, option premium. Okay, but that is something you can't withdraw. Apart from this option amount, you have to add some additional money, which is either 20% of stock value minus OTM or 10% of stock value. So you'll have to then, whatever the margin account balance you calculate using these formulas, okay, using this formula, you'll have to then subtract the option value from it. That is the excess money you need to add in your margin account. Okay, that is the excess money. Because the moment you take short position, CCP will deposit 100% of option value in your margin account, but you cannot withdraw it. Okay. And in addition to that, you will have to add some more amount, which is the greater of these two, 20% of stock value minus OTM or 10% of a stock value. So be careful when you read the question, okay, and when you find the result. Now, another use is in the short sale. So what is shorting a stock? First, what you do, you borrow the stock. Then you sell the borrowed stock. Then at later time, you purchase the stock back, you purchase it back and return it to the lender. Okay, this is what we call shorting a stock or short sale in simple terms. Okay, who benefits? Benefits when it benefits people who are actually bearish about the market. Okay, and their expectations turn out to be true. So when the prices are falling, short sale is beneficial. So what you do when you borrow it, let's say at the time of borrowing, the stock price was 80. Okay, and then you sell it immediately the moment you borrow. So you receive $80 cash. You wait for some time, keep your cash reserve and wait. After some time, the stock price falls to 60. Then you buy the stock back. Now you pay only $60 and you give back the stock to the original owner. you end up with 20 rupees excess. That's a benefit. Okay, this is how we benefit from the falling market. Okay. Now, in this case, what is the initial margin? So initial margin is 150% of the stock price. So if let's say you are short selling one share only, okay, just to keep things simple. And let's say that the stock price of that share is 100 rupees. Okay. So when you short sell it, in your margin account, you need 150 rupees. Okay. That's your margin account balance. But how much is your contribution in this case? Your contribution is not 150. How? Because the moment you short sell, your account gets credited with $100 or 100 rupees. Why? Because during short sale, what happens? Borrow and sell. So you have sold it. So you get the stock price immediately, 100. And now you only need 50% more money, 50% of $100. Okay, that is $50 is something that you need to contribute into your margin account. $100 is contributed through selling the borrowed stock. Okay, but again, this money is not withdrawable. Okay, whatever is in excess of this can be withdrawn. Okay, and at all times you have to maintain this balance. Okay, that is 100% of sales proceed plus 50% additional contribution. Now there is a maintenance margin also, which is 125% of the stock price, which if it goes below 125%, you will have to bring it back to the initial margin level. Margin account balance is adjusted for stock price changes. Like daily settlement structure is there, variation margin will be there, things like that. Okay. Additional margin if balance fall below the margin, maintenance margin. You will be there will be margin call if the balance goes below the maintenance margin level. Okay. Next, buying on margin. You can buy things also on margin. Okay, so let's say you have 1,000 rupees, you want to buy a stock and you feel like, okay, this stock will definitely go up. You want to buy more stocks. How will you do it? Okay, you will buy on margin. And this is provided by multiple many platforms, I would say. Okay, like Kotak Securities, I think is there, which provides buying on margin facility. All others also, like there are many in India if I talk. Okay. So buying on margin, you borrow funds from a broker to buy shares. Okay, and how much you can borrow? You can borrow, and in this case, the initial margin is 50% of the stock value and maintenance margin is 25% of the stock value. Okay, that's your initial margin. Now, let's say you buy margin, you buy 1,000 shares at the rate of 60 per share. So here cash deposit or margin balance will be 30,000. You will have to give 30,000 and remaining 30,000 who will give? Broker will give. Okay, you borrowed it from the broker. However, this share will be kept as a collateral in this case. You can't use this share now. Okay, this share is a collateral. It acts as a collateral. Okay. Stock price falls to 55. Value of share become $55,000. Loss is 5,000. Maintenance margin account balance will fall by 5,000. Okay. Maintenance margin is 13,750. Clearly, my margin account balance is greater than the maintenance margin. So there will be no margin call. Okay. Second scenario, let's say value of shares decline, stock price falls further to $39 per share. Value of my share is now $39,000 total value because I have bought 1,000 shares. My further loss is 16,000. I'm not concluding this, including this loss. Okay, this has already been deducted. Daily settlement. Okay. So further loss is 16,000. My margin account balance becomes 9,000. My maintenance margin becomes 9,750. Clearly, my margin account balance is less than maintenance margin. So I'll have a margin call. Okay. And I'll have to bring it back to the maintenance margin level. Okay. I'll have a margin call worth $750. Next, over-the-counter markets. So what are over-the-counter markets? As of June 2019, you see, if I talk about the over-the-counter markets, it is 5 times the size of the exchange traded markets. Okay. And value of transactions is less than 2% of the underlying value. Underlying value means the notional you can say. And value of the transaction means actual value, actual exposure. So if let's say the nominal is $50 trillion, then the actual value of the transactions are somewhere around, I would say 2% of that. That is how much? $1 trillion is the value. Okay. And the most popular derivative in the over-the-counter market is interest rate derivatives. Next, we have derivatives tailored to end user needs. What the most important benefit is that the derivatives can be customized as per the needs and requirements of the parties. Okay. Bilateral clearing in OTC derivatives. Most of the time you will see that the derivatives are cleared bilaterally. However, now in the next chapter, I'll tell you how certain counterparties are being engaged in over the counter market also, and how they are benefiting out of it. Okay, and how the things are changing. Since bilateral clearing is there, we have a high credit risk. And this is the formula to calculate the credit risk, where if V is the value of exposure, credit exposure is max of V or 0. That means unless and until you have a positive value for a transaction, you don't have a credit exposure. If you have a negative value, you don't have a credit exposure. You have a credit exposure of 0. The other party has a credit exposure now. Okay. And what is your potential loss? Your loss is basically the value of the positive value that you have, the positive value of the derivative. Okay. Now, expected loss on defaults depends on lives of the derivatives and counterparty default probability. So these are the two things on which the default can depend. How long the derivative will live and what is the default probability of counterparty, like how credit worthy the counterparty is. Then there was a major factor which actually led to a major change, and that happened in 2007 and 8 financial crisis. And because of that, we saw an evolution that now we have counterparty risk mitigation through CCPs. That means we are switching from bilateral to CCP clearing. Okay. However, as of now, the actual environment, if you will see, it is more like a web. Okay. So there are many bilateral transactions also happening and many centrally cleared transactions also. Okay. So it's like a web. It's not as simple as we have the structure for exchanges. Now, bilaterally cleared OTC market. First, we'll understand that. There we have netting and collateral. So what happens there is that there is a master agreement done between counterparties. Okay, there is a master agreement done. The details of master agreement is given by ISDA. Okay. And this master agreement includes netting component, which says that if one party defaults, all outstanding transactions can be treated as a single netted transaction. Okay, so let's say there are two parties, they have multiple transactions. Okay, few long positions, few short positions in different types of derivatives. Okay, so master agreement states that if one of the parties default, all these transactions will be netted into one transaction, and the net of the position will be considered. Not each of the transactions will be considered separately. The problem with considering each transaction separately is that if, let's say, defaulting party is long on something, okay, then that payment should be received. But if the defaulting party is short on something, then that payment cannot be recovered. Okay, so that's the problem. So that's why netting the position becomes really important. Second, collateral, which is details of which is given is stated in the CSA, that is Credit Support Annex, where the details of collateral is explained clearly. What the collateral is, how it is calculated, what all can be provided as collateral, the other features, everything. Okay, so it specifies the ways of collateral posting, types of collateral to be posted, and methods of calculating collateral amount. That what is the collateral amount needed. Okay, all these things are specified in the Credit Support Annex, which is a part of master agreement only. Then you have other components, which includes the variation margin, who will be the underwriter, who will be the third party to keep the collateral, everything, other components. Okay, now let's understand certain entities which are specific to over-the-counter market. First is the special purpose vehicles, which is called SPV. Okay, so when SPV is beneficial, so let's say there is an original company who has a large high risk projects, okay, asset portfolio, okay, large high risk projects, or has asset portfolios. Okay, let's say a loan portfolio, for example. Okay, large loan portfolio. Now, what original company does, it creates a SPV, a special purpose vehicle, or SPE, a special purpose entity. This entity is legally separate and independent of the original company. Okay, it is legally separate. It's not the company's part, but it is created by this original company only, SPV. Okay, now what this SPV will do, this original company or the bank will transfer the portfolio, let's say in our example, loan portfolio, to the SPV. Okay, it will transfer the portfolio to the SPV. Then SPV creates the securities out of it and sells it into the market. So the thing is, the bank is actually able to empty its asset portfolio, or in other words, it is able to. So when it happens, when this asset portfolios are transferred, SPV pays money to the original company. So they are left with now free capital, more free capital. Now the loans that they had in their own books have been transferred to someplace else, and they now have the money which they can use to give out more loans. Okay, so that's the SPV. Now SPV are actually entities of OTC market, because here we can't do trading. Okay, they create the securities, they get the ratings, required ratings, and they sell it to the institutional investors who buy them. Okay, they can continue operations even after the original company defaults. Okay, that means because they are independent and legally separate from the original company, they have a higher credit ratings, AAA rating. Okay, they create derivatives from the asset portfolios and transferred by the original counterparty, original company. Okay, derivatives in the sense they may create asset-backed securities, mortgage-backed securities, and things like that, which can be sold in the market. Okay. Now let's understand DPCs. However, nowadays DPCs do not exist, but they were existing at the time of they were in existence at the time of the 2007 and 9 crisis. So it's important to understand what these companies are. So let's say there is a dealer. Okay, the dealer has a poor credit rating, and there is some company who wants to do a trade. Okay, so how this dealer can facilitate the trade? So this dealer, okay, company wishes to do trade with the dealer. Okay, now what this dealer will do? Dealer creates a derivative product company. Okay, and this derivative product company will enter into a trade with another company. Okay, now what is this derivative product company? It is well capitalized. It is capitalized in such a way that this DPC has a rating of AAA. It takes virtually no market risk. Why? Because it's just an intermediary. Okay, it's just transferring from one party to another. Parent company default can affect its counterparty. So if dealer defaults, then this company will be affected in this case. Okay, so here DPC actually trades with another company will actually trade with the DPC, not directly with the dealer, because dealer has a poor credit rating. Okay, but DPC has a good credit rating. Okay, but during the time of crisis, the fault in this structure was highlighted to its fullest, and DPCs are virtually non-existent nowadays. Okay, and here just the offsetting trade with the dealer. Okay, dealer basically acts as a counterparty here only. Okay, and in a way, if you see, this structure looks like the central counterparty structure. Okay, however, DPC was not independent of dealer, because if dealer defaulted, DPC was in a serious problem, and this thing happened during the crisis. There was a serious problem, and a lot of defaults happened because of that, and hence nowadays we don't see DPCs, derivative product companies. Okay, so that's the end of this lecture. Okay, so now we're going to start with FMP 6, that is central clearing. And in this chapter, we will see the central clearing structure inside out. Okay, so let's start our discussion without wasting any time. So first thing that we will need to discuss is the introduction. So first is derivatives exchange. Okay, so what is derivative exchange? It is basically organized with CCP as counterparty to member traders. Okay, so it's similar to what we studied in the last chapter. There we were talking about exchange in general. This exchange could be commodity exchange, equity exchange. Here we are talking specifically about derivatives exchange. It also has a similar structure. There is a CCP, and then there are members who trade through CCP. Okay, there are rules for margin calculation. We know, we have studied the rules in the previous chapter as well. And they have structures for efficient handling of credit risk, the 4 layers of protection: variation margin, daily settlement, initial margin. Then we had um, default fund contributions. And then finally, at some point of time, we saw that, okay, equity of the CCP was at risk, efficient handling. Now, if we talk about the CCP failures or near failures, so these are very rare. They have not happened. However, they have happened not too frequently, I would say. They have not happened too frequently. There have been instances over the last 50 years of history. If you'll see, maybe only 2 or 3 instances are there where a CCP might have defaulted. Okay, however, there have been near misses. Okay, so first is Caisse de liquidation, which is a French CCP, and it failed because of the sharp decline in the sugar cane futures price. Okay, then you had the Kuala Lumpur commodity clearing failing. Okay, there was the failure of Kuala Lumpur commodity exchange or commodity clearing in 1983, and it happened because of the falling palm oil futures prices. Okay, so usually when the prices fall, short position holders were not able to meet up the obligations, and it created problems. Okay, and too many defaults happened altogether. Too many defaults. So that led to a scenario where they were not able to meet up the losses, and ultimately they failed. Okay. However, we have seen some near misses also, like CME, Chicago Mercantile Exchange. It nearly failed in 1987 while handling the S&P futures price, because in that year, on a specific day, there was a sharp decline of 20%. Okay, for an index, a decline of 20% in one day is huge. It's like if I talk about the Indian index, which is currently NSE, Nifty, which is currently at I think 22,000 or something. 20% declines means in a day, it falls to 18,000. Okay, that's a 4,000 decline, 4,000 points decline. That's huge. Okay, it's drastic. And in these scenarios, there will be huge margin calls, and if too many people default, then it can lead to problems. Okay, however, CME barely managed it. Okay, there was a scenario when it was felt like, okay, no, it will default, but somehow it managed to close out all the positions. Okay, now what are the lessons learned from these things? First, we need to understand the effect of changing market conditions, and our risk management structures, our any structure, be it netting, variation margin call, or initial margin requirement, everything should incorporate the effect of changing market conditions. And for this, we need to adjust initial margin requirements as per the changing market conditions. So if the market is less volatile, I'm keeping initial margin requirement low. But if, let's say, over time the same market becomes more volatile, let's say sugarcane market becomes more volatile, so I should naturally increase the margin requirements. Okay, then frequent monitoring of member positions. We need to frequently monitor the member positions, that what is happening, how it is happening, what are their exposures, kind of things. Okay, and then intraday margin calls. Usually margin calls are made at the end of the day, but if the market is more volatile, then it is up to, nowadays it is a rule. Okay, it's up to the exchange to decide if they want to make a call between the day or not. So let's say 2 hours are passed and your stock price, the stock price value has fallen significantly. Okay, so they can make a margin call at that point of time immediately, and you will be given a period of like 1 hour or so, and you'll have to meet up that call. If you're not able to meet up, position will be closed. And these are all ways to safeguard the CCP from risks. Okay, then second problem was not meeting margin calls, and this is the biggest problem. Margin call is made and you are not meeting it. If lower number of people do it, it's not a problem, but if too many people do it in unison all together, then it creates problems. Okay, how will they close out? So closure of member position and enhanced risk reduction measures needs to be in place. Okay, for this. Now here, some similarities and differences has been given between exchange and CCP, which I would not explain. You can go through the slides, you will understand what it is. Okay. Now CCP for clearing OTC transactions. In OTC derivatives, how we have CCP structure, we will understand that. First, global. Okay, on the global scale also we have certain CCPs, OTC CCPs, okay, which are global. Examples are Swap Clear, LCH ClearNet, which is in London. Then you have Clearport CME Group Chicago. Then you have ICE Clear Credit by Intercontinental Exchange, or ICE. Okay, all these things are global, are critical for global financial system, and they are considered too big to fail. Okay, so you can say in a way that no matter what happens, if these institutions come under crisis, governments will run to rescue them. Okay, there will be multiple bailout packages because they can't fail. If they fail, the global economic system will collapse. Okay, nobody can save it. So that's why almost certain to receive a bailout at the time of severe crisis. They have limited cooperation between CCPs, but significant economies of scale, because trades are large scale transactions. Okay, the transactions are large, are huge transactions. Okay, however, the cooperation between two CCPs is not too much. Okay, then you have regional CCPs, which are systemically important for a certain region. For example, India has its own CCP through NSE and all. Okay, important for serving local financial institutions. That's first purpose. Second, important for clearing local currency transactions. Third, may need bailout at the time of financial crisis. Of course, if Indian CCP comes under threat, then Indian government will come to its rescue. Okay, because it is systemically important for the Indian economy. They cannot leave it. Next, merger between CCPs and takeover of smaller CCPs are common. You can see multiple instances where a large CCP takes over a smaller one. Okay, so maybe let's say ICE Clear Credit might take upon some regional CCP, and they now work in unison. Okay, they now work together to transact local trades also, and then international trades as well. Okay, so these are the things that usually happen. There are takeovers happening. Now, how do these CCPs operate? So operation of CCPs, first we'll see the overall structure. Structure is pretty simple. Revenue from fees per trade, they get revenue. They also earn interest on excess initial margin. Excess profit, whatever is in excess after meeting up the costs and everything, whatever excess is left is actually distributed among the member owners for the uh, member owned CCP. If let's say there is a CCP which is created by 10-12 members, okay, they came together and they formed a CCP. Okay, so if this CCP makes any profit, excess profit, then this profit will be distributed among the member companies who created the CCP. Then you have competition, basically, that is actually encouraged among the CCP, so that banks, institutions get competitive prices, and they are subject to rigorous regulation. And it is natural to understand they are too big to fail. If something bad happens, entire financial system will go. Oh, okay. So that's why they are subject to very strong regulation. Okay, they are highly regulated. Then finally, they are prohibited from taking any unrelated risk. Let's say they are into swap clearing. Okay, now they can't go for derivatives like futures on commodities or something like that. It's unrelated, so they are not allowed to do that. If they're into swap clearing, they have to focus on swaps only. Okay, and they operate as public utilities in their core clearing function. Okay, and that is their core function, that they have to clear everything, and they are public utility companies. Okay, even if they have been found by a group of companies, the CCP is now a public entity, public utility company. Okay. Then risk management. How do they manage their risk? There are multiple things. Member required to post initial margin, variation margin. Then you have default fund contributions. Okay. Then they always operate with matched book. So they never keep any loose ends. Okay. Like if a long position is there, they will immediately find a short position. They need to keep their books matched. Okay. So that no net exposure is on the CCP at any point of time. When calculating the initial margin, it is usually calculated based on the historical data. And the aim is to achieve a 99% certainty that the loss over the 5-day period will be covered. 5-day period after the default will be covered. Okay, this is their main objective. If let's say there is a lack of historical data, then they use sophisticated models to find out this 99-day 5% loss coverage. Okay. Then finally, default handling. How do they handle default? First, market risk during default of members. First is the risk of market. So if let's say a member has defaulted, then the transactions on which the member has defaulted, its price might start to fluctuate. That is the first risk to manage. Then if let's say they have the initial margin insufficient, if they find the initial margin insufficient, then the default fund is used. CCP of the equity of the CCP is actually used only in extreme cases. And till date, we have not seen one. Okay, where equity was used. Now, then they also do auction to offset defaulting members' position. So let's say I have defaulted. So I had 4 positions open. So what they will do, they will auction these 4 positions in the market among the members. They will call that, okay, on this day we have the auction, bid and take this position. Okay. Now, one would say that why auction won't fail? Why would anybody buy this position in the auction? Okay. So the reason is simple. If they don't buy it, the loss will keep on culminating, and ultimately, in order to cover up the losses, the CCP will first use initial margin of the company, then the default fund contribution of the defaulting company. And once these two things are wiped out, then natural thing that will be used will be the default fund contributions of other members. So they will feel like, okay, my money will be used to cover the losses. So better, let's keep that money reserved. Let's buy this position out. Okay. And sometimes also what happens is that if auctions fail, one reason of not failing is that members feel like, okay, their contribution is at risk. Okay. Another reason, if let's say even if after doing everything, let's say auction fails, then in that case, members can actually, the CCP can actually allocate losses to the gaining members. So let's say there were 10 members, one member defaulted, and those positions are making losses. So whatever the loss is, the CCP has full right to allocate this loss to other members who are making profits. So let's say there are 4 members who made a profit of, on certain transactions through CCP, they made a profit of $1 million each. Okay. And let's say the CCP has to cover a loss of $500,000. So he may cut $100,000 from each of the profits. Okay. And may only give only $900,000 to each of the gaining companies. So they will feel like, okay, I earned 1 million, and now I'm getting only 900,000. Okay. So because they have the right to allocate. if auction fails. And another alternative that they have in the case of auction failure is that tier up transaction. So they will just take out one transaction and say that, okay, you member C, you will honor this transaction. Then another transaction, member D, you will honor this transaction at random. They can do that. Okay, because they have to survive. They have to survive. Okay, but usually auctions do not fail. Okay, auctions are done on time. Even at the time of 2007-9 crisis, auction didn't fail. Okay, Lehman Brothers positions were all auctioned in time within 7 to 10 days, I think. Okay, everything was done properly. Now, what is the regulation of OTC derivatives market? So regulation, basically major regulations came after the 2007 and 9 crisis only. Okay, and first one was G20 Leaders Summit was done in Pittsburgh in 2009 and certain decisions were taken. The highlights were, first, OTC derivatives need to be standardized. Okay, and similar to exchange, they should be traded on electronic platforms, and this should be completed. This process should be completed by the end of 2012. Okay, clearing through central counterparties. There should be a central counterparty, and standardized OTC derivatives should be cleared through central counterparties. And then reporting to central trade repositories. Okay, so there was a central registry created where any trade, be it standard or non-standard, okay, all trades have to be reported there. There should be a note about each of the trade that has happened. Okay, and then finally, non-centrally cleared contracts were subject to high capital requirement. Okay, so if you are clearing a trade non-centrally, that means you have created a non-standard derivative contract. So in that case, the margin requirements will be higher than what the margin requirements would have been if this contract was standardized. Okay, these were the highlights. What were the major regulations? Again, the highlight actually get transformed into the regulation. Standardization we saw, CCPs we saw, electronic platforms were introduced. Okay, all trades were reported to the repositories for regulatory oversight. Then objective of the regulations, what was the objective? Objective was reduce credit exposure, minimize interconnectedness. If multiple parties are interconnected, then it can lead to domino effect. Okay, mitigate systemic risk, and all the systemic risk is now on the hands of CCP. Okay, improve price transparency through standard transactions and electronic platforms. Okay, and provide regulatory oversight through central repository, reporting of trades on central repository. All these things happen. Next, what are the standard and non-standard transactions? We'll see. And what are the central counterparty clearing rules in these regards? Okay, so first, standard transactions. Terms are standard within the market. These are they use generally accepted models to value the product. Okay, they don't use too many sophisticated model out of the blue. They have brought something and they're using it to value, which is not easy to understand and interpret. Okay, it should be generally accepted models that are used to value a product. Then the product must be traded actively. In order to be traded as a standard transaction, the product must be traded actively. The difficulty in unwinding positions and obtaining an up-to-date valuation. This is a problem with standard transaction. There is a difficulty in unwinding position. Okay. Then cleared through CCP. They are always cleared through CCP and they are subject to standardized rules and regulations. Okay. Like what is the initial margin, variation margin, everything is decided on a standardized basis. Okay. No bilateral. If we have non-standard transactions, first they are bilateral and they are not cleared through CCP. Okay. And what are non-standard? So it can have any property. Let's say the asset is not traded actively, the product. Okay, so they will have to then switch to bilateral. They will have to then switch to convert this transaction into non-standard. Second, they just tweak certain terms and condition of the standard of the standard contract only. Now it becomes non-standard. Okay, and it can be cleared bilaterally. And however, the thing is they are subject to additional regulations to prevent them from avoiding standardized rules. As I said that they may tweak one or two clause of the standard contract only, and it will make it non-standard. So what they do, the moment it becomes non-standard, now you have completely different margin requirements, collateral requirements, everything. Okay, you are now facing more stricter regulations. So due to that, and why this is done, just to switch from bilateral to central. Then here actually the collateral value that is decided, or you can say the margin requirements that are decided, are actually should be sufficient enough to cover the losses over a 10-day period during stressed markets at a 99% confidence level. Okay. Now for standardized contracts, it is 5-day period, but for Bilateral, it is 10-day period. Okay, because it's a bilateral contract, it is more customized, it is not non-standard, so it can be more difficult to close out the position. Okay, and that's why 10-day period. Then G20 meeting, another meeting was held because they saw that bank have now started to bypass the standard transactions by just tweaking a little bit. Okay, so they were said that joint CCP cleared counterparts in being subject to initial margin and variation margin requirements. Okay, no matter your transaction is bilateral, your standard or non-standard. For initial and variation margin requirements, you will have to go through CCP only. Okay, first thing that they did, no bilateral arrangement there. Then they put in place certain regulations, certain rules to avoid slight non-standard features. Okay, so as I said, what they started doing, banks, they would just tweak one or two features to make the contract non-standard so that it can be traded, it can be settled bilaterally. Okay, here in the 2011 summit, they removed this issue, they addressed it. Okay, so if you are doing these kind of transactions, let's say if it is interest rate swap, then you will have to go through standard contract only. You cannot have non-standard transaction. No matter what is there, there is master agreement, ISD agreement, use it, copy it, do certain changes according to the transaction needs. You cannot tweak them, okay, too much. Now the move to central clearing. So earlier these were the structures that it looked like there was no central counterparty, but after central clearing, the structure looks like this. However, this is more visible. This structure is applicable in the case of exchange only. Okay. Now, in reality, we have a mix of bilateral and central clearing. So non-standard transactions are there and transactions with non-financial users are there. So let's say there is a company who is not a financial institution. So they cannot directly clear through, they cannot go for centrally cleared transactions. They will then go through a non-standard transaction. Okay. However, this transaction will be reported into the central repository. There is no doubt about it. Okay. It will be reported, but the transaction is bilateral in this case. So that's why we cannot have a complete shift towards central clearing in the case of OTC market. Okay. Standard transactions and some other non-financial end users are cleared through the CCP. Okay. And more than one CCP exists, leading to trade being cleared through different CCPs for the same participants. So there are multiple CCPs. So I can choose like, okay, one transaction I'll clear it through this CCP, another transaction I'll clear it through other CCP. Okay. Then finally, you have clearing for non-members who are non-members. So this is the scenario for members. But if you're non-member, then how things are done? Small financial institutions, non-financial companies must clear trade through members. So again, structure is quite similar to what we had for exchange. So between exchange and members, there is a direct interaction. Okay, but between a person who is not a member, so there has to be a member in between, and then there will come the exchange or CCP. Okay, in the case of OTC market. Okay, net need to post initial and variation margin with the CCP member clearing their trade. Okay, the initial and variation margin is there. And then finally, you have the settlement of transactions. Okay, that means they are not settled daily, settled often periodically, and sometimes at the end. Okay, so in case of exchange, we had daily settlement. Every day some settlement was done. In case of OTC derivatives, it's not done. There are multiple reasons for it. First, it can be computationally time consuming. Second, we may not have um, uh, uh, price discovery for the underlying variable. Okay, we may not have that. In exchange, we have contracts on actively traded assets, but here in OTC market, we can have contracts on many things where there is some delay in the market price that I can get. Okay, so due to these reasons, these are not settled on a daily basis, but they are done periodically. Next, CCP value these transactions and transfer is done. Okay, so variation margin is transferred from one party to another. Okay, but settlement is not done. Interest is paid on variation margin also. Why? Because they are taking the variation margin whenever needed, but they are not settling it. So they're not settling it. That means CCP is keeping with themselves the variation margin. So interest has to be paid on the variation margin also. So that's one more defining difference between the exchange CCPs and OTC CCPs. Exchange CCPs pay no interest on variation margin, because variation margin are taken and then settled into the account. But in case of OTC CCPs, they pay interest on variation margin also, because they are taken but not settled. In other words, not paid. Now, what are the advantages of CCP? There are multiple. In fact, easier exit, interoperability, then that means, however, it is not common, but it can actually help reduce the margin requirements. If let's say I am doing 4-5 trades with 2 different central counterparties, so I have like mini margin accounts open. Okay, so if they could operate among themselves, within themselves, okay, they could communicate within themselves, then I can actually, it can help them reduce my uh, I would say margin requirement. Okay, that's something that can be arranged. However, it is not practiced too much. Third is loss mutualization. If there is a loss, credit risk is shared among the members. Then you have risk oversight. They can monitor portfolios of the members extensively, thereby limiting excessive risk taking. So they see that, okay, these members are taking these trades, these members are doing this kind of trade. If there is some member who are doing abnormally risky trades, they can immediately restrict the trades of that person. Okay, so in that way, limiting the exposure, okay, limiting the chances of default. Standard documentation is there, which encourages the development of standard transaction documents. Basically, standardized contracts are traded, which can easily be facilitated through central counterparties, and efficient management becomes possible. Okay, because you have a lot of things. You have margining, you have netting, you have settlement, you have default resolutions, everything in place. Okay, so the management of transactions become quite easy for the CCPs. Then what are the disadvantages? First, moral hazard. Moral hazard means market participants may have now reduced incentive to assess risk when they are entering into a transaction. Why? Because they will feel like, okay, I have to do a transaction now. I'll do it through CCP. So whatever the risk is, CCP should be worried. Why should I care about anything like that? Okay. So these members will be less inclined towards assessing the risk profile. Second is adverse selection. Depending on the counterparty's credit worthiness, the dealers may decide whether they have to clear the trade through CCP or clear the trade bilaterally, because both the structures actually exist today. Okay, so what they can do? So if let's say a member finds that, okay, this counterparty is highly risky, if I do a bilateral agreement, then I will be at risk. So let's do one thing. Let's clear this transaction through the CCP. Then there is another counterparty who is highly creditworthy. They feel like, okay, in this bilateral agreement, I'll be in a benefit. There will be a very low chance of loss. So let's do bilateral agreement. So what is happening? Only those parties who have lower credit rating are actually channeled through the CCP, thereby increasing the risk for the CCP overall. So and if the CCP fails, financial system collapse. We know that, right? So that's another disadvantage. Third, we have pro-cyclicality. Usually what happens let's say, uh, if let's say there is a crisis, okay, that means volatility increases. So usually CCPs will do what? They will ask for more margin calls. Now, if there is a crisis in the market, the companies are already in the crisis. They are already facing liquidity crunch. Okay, in order to survive for the business. Now they are getting margin calls from the CCP also. So it will spiral it down. Okay, it will increase its severity. So that means you can say double pressure. Okay, that's what we call pro-cyclicality. High margin requirements during stress times can increase its severity, increase the severity of a stress period. So the crisis which was small might then spiral into a big one. Okay. Then limited credit risk information. Sometimes default fund contributions can be at risk as other members lack visibility into other members' trade. Okay, it's the only CCP who knows what all the members are doing, but member A doesn't know what member B is doing, what kind of trades member B is doing through the CCP. So member A has limited credit risk information, and he might feel that, okay, my default fund contribution is at all times risk. Okay, so that's the disadvantages of CCPs. Next, what are the risks of OTC CCP? Key activities. First, we understand what are the key activities. Again, admitting members, valuing transactions. They are very simple institutions, not like banks. Okay, determining initial margin, determining fund contribution, margin netting, managing variation margin transfer system. Okay, these are the key activities. If we talk about the features, first, too big to fail. Very simplified structure. Only few activities are their main activities. Effective regulation. They are under strict regulation. We know that. Operational resilience. Their operational resilience is top notch. Okay, they need to have very high operational resilience that no matter what happens, we will be able to execute. Okay, and one example of all these things, operational resilience, is that they were actually able to successfully handle Lehman Brothers bankruptcy. Okay. Next, what are the risks? First, positive correlation among member defaults. We know that during the time of crisis, all correlation go to 1. Okay, it's the said proverb in the finance world. And although it's not completely true, but yeah, it's partly true as well. Okay. So if one member defaults, chances that other members will default also increases, especially during the time of crisis. So that's another problem. So there will be a domino effect. Now CCP will be at huge risk then. Next, members are treated equally for equal initial margin and default fund contributions. That's a problem. Okay, why? Because they should actually assess the credit worthiness. If a counterparty is less credit worthy, then there they should ask for more default fund contributions or more initial margin requirements. Okay. Next, we have a risk of potential auction failure, which can lead to forced loss sharing and reputation damage. If let's say an auction fails, first it comes to the reputation of CCP. That this CCP cannot handle defaults properly. So let's not do transactions through this CCP. Okay, loss of reputation. And second, since they are forcing the loss on other non-defaulting members, again, members will feel like, okay, no, it's not worth it. Okay, whenever there is a loss, this CCP always throws the loss, patches up the loss onto us. Okay, so they will start withdrawing as members from this CCP. Okay, next, risk of fraud, computer system hacking, that the general losses that any other institution might face. And then risk of valuation models performing poorly that can alter initial margin requirements. Again, this was the issue that happened during time of crisis also. When initial margin were being calculated, the historical data for the derivatives was not available too much. Like CDOs were there, CDO square were there. These were relatively new assets in the market. And we didn't had any large historical information. So it mostly the calculation of initial margin or anything or value also depended largely on statistical models. Okay, and that was faulty. And if that happened, models performed poorly and initial margins were set incorrectly, which led to defaults, a lot of defaults. Okay, so that's another risk. And then risk of liquidity loss during stressed market conditions. So they need to ensure that they have sufficient liquidity risk management steps in place in order to get access to liquidity at the time of crisis. Okay, so that's the end of this chapter. Now 4 chapters are still left, so now we'll have a kind of a break, a lunch break. Okay, so half an hour break, and then after that we'll start with the remaining 4 chapters. Okay, so don't leave the meeting and just stay in the meeting, and just let's have a half an hour break. Okay, so now we are going to start with FMP 18, that is mortgage-backed securities, mortgages and mortgage-backed securities. In this chapter, our objective is to understand mortgages in detail, like how the EMI payments are calculated, how the amortization table is built. And also in this chapter, we will see calculation of interest component, principal component for every month EMI. Of course, these are the parts of the amortization table. And finally, the outstanding principal. Let's say after a loan has been issued and some year has passed and it is still living. Okay, so in that case, that means the loan has not defaulted. So in that case, what will be the outstanding principal? Then we will see certain factors that affect prepayments. Okay, so prepayment, what is it? If I talk about prepayment, it's basically the early payment of loan principal. Okay, so let's say you took a loan for 2 years and you have paid the EMI for 1 year, and then whatever is left, you closed it out. Okay, that's a prepayment. That's full prepayment, we call it. Okay, so after this period, you are not required to pay any EMIs. So, and then you have partial prepayments where, let's say you take a loan and after 1 year, you decide that, okay, I have some extra money with me, so I will pay 30,000 extra. Okay, this also leads to a principal reduction, and it may not have a direct effect. It has a good, it is good for the borrowers because they are able to reduce their obligations. But it's not a good news for the investors to whom these loan mortgages are actually sold in the form of securities. Because for them, it's like if it's a 2 years mortgage, so they were promised to get interest and principal payments for the next 2 years. But if the prepayment happens, then after 1 year, then they lose 1 year of interest and principal payments. Okay, interest payments, they receive the principal, of course, but interest payments, they lose it. Similarly, in the case of prepayment, same thing happened. Like they lose some interest payment, some income in the form of interest payment that they might have received if there was no prepayment. So prepayment definitely is really important. So there are certain factors which drive prepayment. So for example, if I am after 1 year, I decide to prepay my loan. Okay, so what are the factors? What are the reasons that will actually lead me to take that decision that I'll have to prepay. Another way, yeah, of course, there is one more way to prepay the loan. So let's say I refinance the loan. Okay, so I took a loan of 5 lakh rupees, for example, and at that point of time, maybe for any reason, I was paying a higher interest, let's say 14% or 15%, something like that. Now, after 2 year passes, I pay all the EMIs on time, my credit score improves. Now I know that I'll be offered better, I would say, better interest rates. Okay, favorable interest rates. So I look into the market and I find out, okay, I'll be able to get and let's say outstanding principal for the time being is 3 lakh rupees. So after 2 years, when I check my credit profile, it's good, and I find out that if I take a loan of 3%, 3 lakh rupees, I'll be liable to pay only let's say um, only 9% of interest. Okay, so here roughly I'm saving 5 to 6% of interest expense in the form of EMIs that I would have paid. So I would refinance the loan. So existing loan will be closed out and I will take a new loan worth 3 lakh rupees. Now this existing loan was actually a part of a mortgage pool, for example, if securities were being created out of it. So although I've taken a new loan, but that new loan will not be a part of this pool, okay, in which it originally belonged. The loan originally belonged. So for that mortgage pool, the loan has been prepaid. Correct. So that's another way in which prepayment can happen. So there are 3 ways of prepayment. First, I make the full payment using all my cash. I make partial payment, or I refinance the loan. In either of these cases, I have a prepayment. And this is a problem for investors. And in this chapter, in fact, in the curriculum FRM, we are studying everything from the perspective of investors. Okay. So you'll assess how these prepayments can have an effect on investors as well. And then finally, we will talk about some mortgage-backed securities, like there are MBS, which are called we have pass-throughs, then we have specified pools, we have TPA, to be announced. Then on to be announced, we have another security which is called dollar roll. So we'll see these things. And then there are CLOs also, CMOs also, which are mostly theoretical in part 1. So I have omitted those parts. You can just go through the study material that you guys have and you will understand. Okay. So let's start our chapter without wasting any time. So what we have here is first calculation of monthly payments. So this is the formula that we actually use to calculate monthly payments, where X actually signifies the EMIs. Okay. R is the annual interest rate quoted with monthly compounding, and A is the loan amount that I'm willing to take. Okay. Amount borrowed, loan amount. It's not the final amount that you will end up paying. Okay. It's the principal amount that you have taken, the loan amount. Now, from the examination perspective, I'll ask you, if I tell you, then remembering this formula is not at all important. In fact, you can use the TVM buttons and you will be easily able to calculate the EMI payments. And for that, what you have to do, you need to understand the difference between a loan and a bond. For bond, when we were doing calculations, we used to first consider N, which was the number of payments that I'm receiving or paying. Then it was I by Y, which is the rate of return, okay, yield. Then we had PV, we have PMT, and we have FV. Now, in the case of bonds, FV was future value was something like, okay, there was an final payment at the end of at the maturity of the bond. It was the face value of the bond, that is $100 usually, okay, quoted. In the case of loan, what happens when you make the payments? Okay, so one similarity is that in the case of bonds, you have coupons. In the case of loans, you have EMIs. Both are similar. These are regular payments that happens at fixed interval of time. But there is a stark difference between coupon and EMIs. One is that in the case of coupon payments, bond coupons, it's only the interest that is paid. Okay, but in the case of EMI, the EMI actually comprises of 2 components. One is the interest component and one is the principal component. So as you pay EMI, your principal amount, that means the face value, also decreases. And at maturity, the face value of the loan becomes 0. Okay, so two difference, one biggest difference between loan and while using TVM buttons for calculating EMIs and all, okay, outstanding principal, whatever, is that the future value of a loan is always assumed to be 0. Okay, then while taking the I by Y, it's the interest rate that you are paying. Okay, however, we know that these interest rates are usually quoted in per annum with monthly compounding. So you need to divide that interest rate with 12. Whatever number you get will be your I by Y. So for example, if let's say I have a 5-year loan and I have to pay monthly installments, the loan is worth 1 lakh rupees. Okay, so here what is the case? The case is my N will be equal to 12 into 5, 60. Okay, rate of interest is, let's say, 12% for the sake of simplicity. So my I by Y will be equal to 1%. Okay, that is 1. Then you have PV, present value. So present value, you are taking a loan of 1 lakh rupees. So 1 lakh will be your PV. Okay, then your FV will be equal to 0. You can just press CPT and then press PMT. That will give you the EMI. Okay, that's how you calculate the EMI. Now, once you know the EMI, then at any point of time, you can also calculate the outstanding principal. These are the two types of questions that are asked. Find out the outstanding principal and find out the EMIs. Okay, most common ones. So for outstanding principal, let's say the 2 years have passed. First, you will estimate what was the EMI. And then in order to find the outstanding principal, now your PV is unknown. All other things you know. Let's say now 3 years is left. So your N will become how much? 30? Sorry, 36. Your I by Y will still be 1. Okay, your PMT now you know. Let's say it's 500, 1000, whatever. Okay, and your FV is 0. Then CPT, PMT. That will give you the outstanding principal at that point of time. Okay, so these are the things that you can do. Okay, using TVM buttons, and that is why I was saying that there is no need to remember this formula. Using this formula will take time to do calculations in the examination, hence not required. Okay, use TVM buttons. It's way too much easy, and you can do it like within seconds, 20-30 seconds, end of the story. Okay, use this formula. You will take more than 4 minutes. Now, here an example has been taken because I need to show you the amortization table. Amortization table basically shows monthly principal and interest payments on a mortgage. Okay, assuming that there will be no prepayment of the principal. That means loan is not going to be prepaid. If that is the scenario, if that assumption is fulfilled, then every month, what is the interest that I pay and what is the principal amount that I pay out? Okay, this is something that I want to find out. Okay, so here an example has been taken, and using this example, we'll build the amortization table. So here we have a 30-year mortgage. So in total, and we have to make monthly payments. Here it is written. Okay, so 30-year mortgage means 360 payments, correct? Each year 12 into 30. So 360 payments. Okay, 360 EMIs. N is 360. Your mortgage is to $250,000. That is your PV, you can say. Fixed rate of interest is 6% with monthly compounding. That means every month your I by Y will be 6 by 12, that is 0.5. Then your FV will be equal to 0, CPT, PMT. You get the answer as $1498.88. This is your monthly payment. Okay. Next, let's see the amortization table. So at time 0, when you take the loan today, let's say today the loan is dispersed. Okay. So you, at the time of dispersal, you pay no EMIs. Okay. After a month, you will start paying. So for the first month, interest is calculated on the complete loan amount of $250,000. So interest is 1250. When you do the calculation, 0.5% of $250,000, you get $1,250. Okay, and you know that you are paying an EMI. You see here, you are paying an EMI of 1498.88. So out of this 1498.88, 1250 is interest payment. So what is your principal payment? The difference. Okay, the difference is 248.88. Now, in month 1, the moment first month is over, okay, you will subtract this amount from the principal. Now, this is your outstanding principal. Okay, next month, in month 2, you will calculate interest on this amount, not the original amount. Okay, this is what we call diminishing balance interest rate calculation. Okay, usually banks use this. So you have this number, you calculate the interest, you subtract it from the EMI, you get the principal component, and you do it till your balance amount at the end of the loan period becomes 0. Okay, now there is a pattern that you can find. If you look at the interest component, these two components combined, whatever all the numbers, no matter where you add them, if you will add it, you will get the EMI amount. For example, 1491.42 and 7.46, just add them, 1498.88, the result. Okay, so you will get the EMI amount. Now, the characteristic that I want to highlight here is the behavior of interest and principal component. Okay, how they change. So if you look carefully, then the interest component actually decreases as the loan maturity nears, or I would say as you pay more and more EMIs. Okay. On the other hand, the principal component increases as the loan maturity nears. Okay. So the more close you are to the maturity, it will have the more principal component. The EMI will have the more principal component, and that's why you will see that as you near maturity, you will see that okay, most of the your principal amount falls drastically. Okay, and during that period, banks usually offer favorable terms if you're trying to prepay the loan. Why? Because they know that okay, interest income is very small. mostly the principal is left. So if they prepay the loan, I'll get these principal, only small fraction of interest income will be lost, and this money can be used to give out new loans. Okay. So that's the objective, and that's why they have favorable terms initially. And from your perspective also, initially prepaying is not beneficial because bank charges are too high and things like that. Okay. So and also you will have to pay large sum of money. So in the last few years, you will have your principal amount falling drastically. Just look at it here from 5,900 to 4,400. But if you look the decline here, when your balance amount is high, the decline is only $248.88. But when your maturity is near, the decline is almost equal to your EMI amount. Yeah, your decline is almost equal to your EMI amount. And finally, it reaches to zero. If you want to see it on the graph, so the outstanding principal, the decline in outstanding principal looks something like this. Okay, just give me a minute. Yes. So decline looks something like this. Initially, it is very high, but as you see, you can say in the later half. Okay, when the maturity is, when the life of loan is very small. Okay, in the later half, like from 250 onwards, the decline becomes very steep. Okay, till this point, it is gradually declining, but later on, the rate of decline actually increases. Okay, the principal amount, outstanding principal falls drastically by every EMI that you pay. Initially, the fall is very small. Now, let's understand mortgage pools. So what happens is that we know originate to distribute model. Okay. So in that, banks originate the loans, and what they do, they have this portfolio of loan, similar loan, they sell it to a third party, usually SPV or something like that. And these SPVs, then they slice these pool into securities, create securities out of it, and those securities are sold into the market. Okay. So the thing is, we need to create mortgage pools. So the portfolio, basically, if it is a portfolio of stocks, we call it portfolio. But generally, if something comes, if I create something by combining loans, we call it pooled. Okay. Now, usually in a pool, we keep loans of similar types. So if it is a mortgage pool, I will keep mortgage loans, and that too, let's say 30-year mortgages mostly. Okay, or 20-year mortgages. I'll create a separate pool which will consist only of 20-year loans, home loans. Another pool which will consist only of 30-year loans that a bank has given. Okay, so for that, it becomes really important that I need to find out what is the weighted average coupon and what is the weighted average maturity. Okay, now what does this mean? Weighted average coupon and weighted average maturity. So you see, the component loans may have different interest rates. In other words, from the perspective of investors, coupons. Okay, and maturity is important, like roughly in what time, you can say, is analogous to somewhat duration. I would not say it's exactly true, but somewhat duration, where you want to find out, okay, roughly in how many years this mortgage pool will pay out all the money. Okay. N is the number of mortgages. CI is the coupon on the I8 mortgage, which can be different. Like let's say it's a 30-year loan pool. Okay, mortgage pool. So in this, I have only 30-year loans. Now, all these 30-year loans are not liable to have the same interest rate. Let's say some had good credit ratings. Maybe they provided some kind of collateral, good collateral or something like that. They got favorable terms. There is another party who have poor credit score, or maybe they were not able to provide good collaterals, so they are charged higher interest rate. So coupons or the interest rates on individual loans are different. Okay. And how the WI is calculated? WI is basically the weight of the loan in the portfolio divided by in the pool divided by the total value of the pool, total principal value of the pool. Okay, principal value. Okay, remaining outstanding principal value. So if today, let's say I have created a pool out of 10 loans. Now, for the sake of simplicity, let's assume that all the loans are of same amount. Let's say $1 million. Okay, so in this case, and it has been originated only. Okay, now I have converted it into mortgage pool. So here the scenario is, weight of each of the loans in this case will be the principal amount of first loan. Weight of first loan will be principal amount of first loan, that is $1 million, divided by the total outstanding principal on the pool. So each loan is worth 1 million. I have 10 loans. So total outstanding value is $10 million, 1 over 10, that is 0.1. That's how the weights are calculated actually. Okay. Next, in addition to WAC and WAM, there are few other statistics that are actually looked upon by the investors. First is the average loan balance that is there in the portfolio. Second is the pools factor, which is basically a way to assess how the value of the pool will decline over time. Okay. Then you have weighted average FICO score. So in a pool, let's say it's a 30-year loan, 30-year mortgage pool. So you need to find out, okay, on an average, what is the risk? Okay. And the first way to assess the risk is their credit score, the borrower's credit score. So let's say there were 10 loans. Now some had higher credit score, some might have lower credit score. Okay. So I just take their weighted average. Okay. And in USA, like in India, we have CIBIL or Experian, something like that, Equifax, three major. So in US, we have FICO, okay, which gives the credit ratings to individual retail borrowers. Okay, so weighted FICO score is calculated. That is something that gives us rough idea about the overall credit quality of the mortgage pool. Okay, then you have weighted average loan to value ratio. Okay, loan to value means the loan and what is the value on which the loan has been taken. Okay, value of the underlying value of the mortgage that has been provided, LTV, loan to value. And then finally, they also look at the geographical distribution of the loan. And this is also important because sometimes concentrating all your, let's say you are creating pool uh, from loans of only one region, then you are exposed to everything that happens in that region. Okay, if your pool comprises of multiple geographical regions, then you are just exposed to the macroeconomic factors. You are not exposed to specific region specific factors. You are exposed to let's say national factors only, like macro factors like interest rates and equity environment, things like that. Okay, so all these things are assessed apart from the weighted average coupon, because weighted average coupons tells you that what is the average income that you will have, regular income, weighted average maturity, by what time you will get all the income, average. Okay, weighted average. And all these things tell us other features. Okay, so each of these factors are considered when you are assessing a mortgage pool. Next, in mortgage pool, we have SMM and CPR, single month mortality and constant prepayment rate or conditional prepayment rate. So what is single month mortality? It is basically the percentage of outstanding principal that is prepaid during a given month in the past. Okay. And this will never include scheduled payment of principal. What does it mean? You see, there are two payments of principal in a mortgage pool. Okay. One is when the borrowers pay EMI. So what they are doing is, in fact, what is happening is they are paying interest also on the outstanding principal, and at the same time, they are paying some principal as well. Okay. So these are scheduled principal payments that are being received along with the EMIs. Okay. SMM does not measure that. SMM actually tells you what is the amount, what is the percentage of outstanding principal that will be prepaid. That means that will be foreclosed in some way or another, in roughly, I would say, in layman terms. Okay. Or let's say some of the borrowers refinanced. Let's say some of the borrowers prepaid the loan by paying cash, their own capital. Some of them prepaid partly. Okay. So banks actually try to assess, like, every month, as the month passes, what will be the mortality rate or prepay rate. Okay, what percentage of principal, outstanding principal, is prepaid? That means of what percentage of principal I will lose the interest income. Okay, on what percentage of principal I'll lose the principal interest income. So if let's say the pool consists of $1 million, of this $1 million, if let's say $100,000 is prepaid. Okay, now this $100,000, if it was paid through scheduled EMIs, it would have taken more time. So thereby, on $100,000, let's say it would have taken 2 years to prepay $100,000. Now, if it has been prepaid today itself, so over the period of 1 year, whatever the interest could have been earned on this principal, even on the diminishing balance method, okay, is lost now. So that's why SMM actually becomes important. Okay, and conditional prepayment rate is basically nothing but the annualized SMM. So SMM tells us single month mortality, that in a month, what will be the prepayment, and constant prepayment rate tells us annualized mortality. That means what percentage of outstanding principal is paid every year, is prepaid every year, not paid, prepaid. Okay. So that's constant prepayment rate. And the formula for constant prepayment rate is 1 minus SMM raised to the power of 12. Okay. And what is the best indicator? How do we estimate these prepayment rates, be it SMM or CPR? By looking at the historical data. Like in the past, for various mortgage pools that actually existed and now have expired, okay, and now have ceased to exist or matured. So what was the prepayment rates in those mortgage pools? We assess them. Then we find similar pools like, okay, there will be 30-year mortgage, 50-year mortgage, 20-year mortgage, 10-year mortgage. We find the historical data and we just look at them, that what was the prepayment rate. And using that, we assume that for this mortgage pool also, the prepayment rate will be similar. And then we calculate SMM and CPR. Okay. And also, as the time progresses, you will have your own historical data, which you can actually incorporate when it actually happens, because these are all the estimates. Let me tell you, SMM, CPR, these are all the estimates. We can never know with certainty, okay, that what will be the prepayment in the next month. Correct. And it is conditional on the remaining mortgage balance. Okay. Usually it is conditional on the remaining. So it also depends on remaining mortgage balance. So as of now, what is the mortgage balance left out of the principal amount? Okay. Now let's talk about some of the assets that are created, MBS. So some of the assets that are created through mortgage pools are pass-throughs. Okay, and pass-throughs are of two types. Okay, first is specified pools and second is to be announced, which are called TBAs. Okay, now in specified pools, what happens? Buyer and seller actually agree to trade certain amount of a specified pool at a specified price. Okay, so they will specify that, okay, this is the mortgage pool that I will sell, and this will be the price at which I will sell. Everything is specified beforehand at the time of transaction. This is what we call specified pool. Okay, and in this way also pools are traded. Now the characteristic of given pool affect the price of the trade. Okay, so if let's say, for example, pool have high loan balances. So generally what is seen that if high loan balances are there, then they are associated with high prepayments also. Okay, so higher prepayments means more loss of interest income. So they would naturally have lower prices. Okay, so they can have an effect. Then you have TBA, so to be announced, where buyer and seller agree on few things. Okay, not the price or the pool. Okay, but few things are there. Sorry, few things are there or that are agreed. First, who will be the issuer? So, for example, in USA, you have Fannie Mae, Freddie Mac. Okay, who actually issue these pools. So first is the issuer on which they agree. Then maturity, which is the original maturity, not the left maturity. Okay, original, that means when the pool was created, it was created of which type of loans, what maturity loans? Was it 30-year pool, 30-year mortgages were used to create a pool, or 20-year? Okay, that's the pool. So let's say this pool was created 5 years ago and it was 30-year pool. So today you will not say that the maturity is 25 years. You will see what was the initial maturity, original. It was 30. So it's a 30-year mortgage pool. Then the coupon, the interest that you will be receiving on this, and then price per $100 of par value. Okay, so loan has a par value, right? A face value, that okay, this loan had a face value of $10 million. So what will be the price? And gradually the price par value falls. Okay. Then the settlement month, that in which month? So let's say today is May, right? We are currently in May. So we're saying that, okay, in August it will be settled. Okay, in August 1, I'll sell you, and August 2, maybe in August I'll sell you. Okay, this is the price. But the difference between specified pool and TBA, in fact, if you look at all these things, it seems like, okay, there is no difference between a specified pool and a TBA. But the difference is in the specification of pool. Okay, let's say I have 3-4 30-year mortgage pools. Okay, what we have agreed is the issuer, the maturity, the coupon, the price, and the par value. Okay, and the settlement month. We have not agreed which of the 4 pools that I have will I give you. Okay, and this is disclosed only 2 days before the maturity. So let's say it's August, and now it's let's say on August 2 I have to 2 days before the settlement. Sorry, let's say on August 2 I have to make the settlement. So on July 31st I'll say that, okay, this is the pool that I'll give you. Okay, in case of a specified pools market, the pool is pre-specified, that okay, this is the pool on which the transaction I am talking about. Here transaction is completed, no discussion about what pool I will get. It will be a 30-year, it will satisfy all these conditions. But I have, let's say, 4 pools which satisfy these conditions. So I have not told the buyer that which of these 4 mortgage pools I'll give you. It depends on me. That is the difference between TBA and specified pools. Okay. Now let's talk about a dollar roll. So a dollar roll basically involves selling a TBA and then buying it back. So it's, to an extent, I would say, similar to a repurchase agreement where you sell it today and then buy it back. Okay, but there are stark differences also. So what happens here is that, okay, currently it is May, right? So what I say, I talk to another bank and I say that, okay, I'll sell you a pool in the month of, on 12th of July. Okay, I'll sell you a specified pool on 12th of July. and then I'll buy it back on, let's say, 12th of August. Okay, so I am selling it in one settlement month in July and buying it back in August. Okay, so this transaction is called a dollar roll. Now you might say that, okay, it's similar to repo transaction. So what's the difference? Difference is pretty simple. In case of repo transaction, what happens? When I sell the security, I sell it at a discount, or maybe if not a discount, then at the fair value. But when I buy it back, some interest is added onto it. Okay, but in the case of TBA, in the case of dollar roll, no interest is added. Okay, D then market price, whatever it is, the transaction will be done at that. No interest component is added. So one might think, okay, what is the benefit then of doing a dollar roll? So the benefit is on 12th of July, I sell this dollar roll. Okay, so I know that on 31st of July, or let's say on 1st of August, whatever, there will be EMI payments happening in this pool. Okay, I lose those EMI payments. And who receives those EMI payments? Who actually bought it from me. Correct? So for this buyer, the benefit is the EMI payments that the buyer receives. And for seller, that's the cost I paid. So that is the reason that while doing the transaction in a dollar roll, by selling and buying it back, no interest is added in extra on the price. Okay, but that's not the case with repurchase agreements. Okay, so that's the difference. Now here, if we want to find the value for dollar roll, so of course you want to find that, okay, what was the value of the dollar roll? So there are 4 factors that you need to consider, and these factors are named A, B, C, and D. Okay, and you need to take the difference between A and B and the difference between C and D, and then add these 2 differences. You get the value of dollar roll. What is A? A is the price at which the pool is sold during the first month. So in the month of July, on 12th of July, I will be selling this. Okay, so the price at which I sell will be considered A. Now, when I calculate the price, I need to also include accrued interest. Now, here also accrued interest comes into the picture. So you need to understand that last EMI was paid on, let's say, 1st of July. So for 12 days in the month of July, I kept it. And then I am giving it to other party. That means I'm selling it. So for the 12 days, whatever the accrued interest is, who is eligible for that? I am. The seller is eligible. So when I'm selling the pool, what I'll do? I will add the accrued interest to the selling price. Okay, and I'll sell it. Then on 1st of August, the other party, let's say B, who bought it from me, receives all the EMIs on that. Okay, that becomes their income. And then on 12th of August, he will sell me back. Okay, that is the price B. The price at B, the B is the price at which the pool is purchased during the second month. From my perspective. Okay, so I sold it in the month of 12th on 12th of July. Now I'm buying it back on 12th of July, 12th of August. Here also I'll add accrued interest. Why? Because EMI was paid on 1st August. So for 12 days of August, that other party kept the pool. So for that 12-day period, who is eligible for the interest earned? That other party. So I'll add it into the price and I'll give that price to the other party and I'll get the pool. Okay. Third, interest earned on the proceeds of the sale from 1 month. So on 12th of July, when I sell the pool, I get the money. And what I do, I invest this money in the market for 1 month period. So I will earn the interest. That is the component C. And what is D? D is the coupon and principal repayment that would have been received on the pool sold. So when I sell the pool, who becomes the owner after 12th of July? The other party. So he receives the interest and coupon payments, principal payments. Okay. So that amount, interest and principal payments, whatever that amount is, okay, that the other party received is considered D. Okay. And the value for me will be the price at which I sold minus the price at which I purchased back, plus the price, the interest earned on the sale proceed minus the payments that I sacrificed, okay, that I had foregone by selling it. Okay. And these 2 are added. Okay. Now, next we have the model prepayment behavior. Okay, so prepayment behavior, you see, as I said, like prepayment can have serious impact on the mortgage pools. If you look at from the perspective of investors. So whenever mortgage pools are created, prepayment behavior is understood properly. And while understanding prepayment, you need to understand the factors which lead to prepayments. And there are 4 major factors. First is refinancing. Second is turnover. Third is default, which is obviously considered prepayment. And fourth is curtailments. Curtailments means you are reducing it to an extent. Okay. So let's see one by one each one of them. And the most common one is refinancing. So refinancing actually arises when you have a borrower that prepays the loan, existing loan, by taking a new loan. Okay. And what are the reasons for doing it? First and foremost reason is decline in interest rate. So let's say I took a loan 2 years ago, and that at that point of time, the interest rate offered to me was, for example, 12%. Okay. Now 2 years has passed, and let's say my credit rating has not changed. Okay, credit rating has not changed. So 2 years have passed, and now what I see that in the market, the person with a similar credit rating that I have could get a loan at 10% interest. So interest rate has declined. Now, if I refinance it, I know that I'll be paying 10% interest only, not 12%. So one reason to refinance. Second, my credit rating has improved. So let's say initially I had no credit score. Okay, I was the first time borrower. Okay, so the problem with me was, okay, I have no credit history. So bank were very about me, that whether I'll be able to pay the payments on time, make the payments on time or not. They literally don't know anything about me if I have no credit ratings. Okay, credit rating. So they offered me a higher interest rate. But since I was a first time borrower, so they had to take the chance. So they offered me, okay, I'll give you the loan, but your interest rate will be, let's say, 14%. Now, for the 2 years, I kept the loan and I paid every EMI on time. Now, the moment I start paying EMI, my credit history starts to build on. And 2-3 years is a long time period where it can have a significant impact on a credit rating. Okay, in fact, if you're using credit cards, you might be aware, if you're in India, then let's say before credit cards, if your credit rating was 760 or 70, and it was increasing very by feebly. Okay, but the moment you take credit cards, and let's say you are good with credit card, okay, don't buy credit card unless and until you are aware of what all are the technicalities. Okay, so what all are the problems, and if you're a heavy spender, then definitely don't buy credit cards. But yeah, let's say you buy it and you use it sensibly. Okay, and you're making all the repayments. So in this case, you will see that within months, your credit score shoots up from 780 to maybe 830, 840, 850 even. Okay, so your credit rating has improved. Now you will get more favorable terms because your credit rating is high. That means the chance that you will default as a borrower is very low. So they have more confidence in you and they can offer better loan conditions. Okay. Then third reason is cash out financing, which can also lead to repayment. Okay. Cash out financing means, what can I say? Like, in this case, what happens is, let's say you took a loan on a house. Okay. Now, after some time, you sold the house. You got the cash and used the cash to pay out the loan. That's cash out financing. Okay. This is also possible. This is one of the reasons that you might refinance the loan. Okay. Cash out financing. Then the extent to which refinancing is possible is actually given by a measure called incentive function. And the most simplest formula of incentive function is I equals to WAC minus R. That is the weighted average coupon on the pool minus the rate of return, the rate of interest that is being offered to you. Without secured loan, CIBIL hardly crosses 800. No, it crosses. It crosses. Take a credit card and use it sensibly. Like for credit cards, we say that you should not spend more than 30% of your credit limit. If you keep all those things, then it will go beyond 800. Maybe not 850. It will go up to 810, 820, something like that. It will cross 800. It is 100% sure. Remain 100% sure about that. But you'll have to adhere to that. That's why I was saying use credit card sensibly, and you see that your credit score shoots up. Okay. Now, I is WAC minus R, where R is the rate of return that is being offered, and WAC is the weighted average coupon. The larger this difference, the more the chances that the people in this, the borrowers of this mortgage pool, will refinance the loan. Okay, this is in the terms of interest rates. And then you have a more elaborate incentive function, which tells you in the dollar terms that what is the net present value benefit you will get if you refinance the loan today, which is given as WAC minus R times ALS, that is average loan size, times A, that is the annuity if you take a loan, minus K, that is the EMI that you are paying. Okay, that will give you the average net present value benefit, dollar value benefit. So let's say today you feel like, okay, your outstanding principal is $300,000. Now you use this incentive function and you find that, okay, your net present value, um, of course, the final result will actually be the difference only. But let's say you under the new interest rate environment, you find that the net present value of the loan should be 250. So there is a $50,000 difference. That difference is your incentive function. Okay, that is the incentive that you get if you refinance the loan. In net present value terms, you will get a benefit of $50,000. Okay. Next reason for prepayment is turnover. So turnover basically is the fact that people who are residing in a region now decide to move out of this place. Now in India, we usually don't see it. Like we don't do turnovers in the near term, in the medium term at least. Like for the, if you have made a house, you will stay there for like 50, 60 years or something like that. Okay. Or even if you don't stay there, you will keep it as an asset. But in other countries, like in USA, you will see that people do shift altogether. Like they will sell their house that they had in the previous location, they move to the new location, they buy the new home there, things like that happens. Okay, so that is what we call turnover. So usually it is seen, and all these things, let me tell you with 100% assurance that we are starting from the perspective of US economy. So in US, it has been found that turnover is usually higher in the summer months than in the winter months because of the ease of travel and all. Okay, whatever is the reason, I don't know. I'm just making guess here. So it is also lower early in the life of the mortgages, and it is understandable. Like if you have recently taken a loan and financed a house, you will not switch your location instantaneously, like immediately. Okay, you will stay there for at least 5-10 years or something like that. Then only you will plan it. Okay, now I should move to Chicago, let's say. Okay, so these kind of things happen. So people do not relocate too frequently. If they are doing it too frequently, they would stay in the rented house. They will not purchase the house. They will not go for mortgage. So turnover is one of the reason. And turnover rate is liable to depend on the geographical location of the properties and on the average age of the mortgage holders also. Okay, like what are the factors that affect turnover in itself? Geographical location. So let's say initially you bought a home at some suburban region. Okay, but then you earned money and you have now you want to go to a better house, maybe in some posh locality or something like that. So you will repay the loan, you will sell the property, use the money to repay the loan, and then go to the new place, take a new loan. Okay, these are the thing. And then average age also matters. Usually younger people are found to do a turnover at a higher rate, but elderlies do not relocate, do not do turnovers too much. Okay, so these are the things that needs to be considered. Then you have defaults. Default, like let's say there is a mortgage holder who defaulted. Let's say he lost his money, everything, he lost his job, now he has no money to pay the loan. So default is actually considered as a prepayment. Okay, here what will happen? The company managing the mortgage pool will take upon the risk and they will have to adjust for that. Okay, we know that in securitization you have studied everything, so I'll not go into that aspect. Okay, but yeah, default is also considered prepayment. Then you have curtailments. Curtailments are partial prepayments. That means you are not fully paying or repaying your loan, but in part. Let's say currently the outstanding principal is $1 million and you are paying out 40% of this amount. Okay, so this is what we call curtailments, and curtailments can rise as high as 5% when your time left to maturity is only 1 to 2 years. Okay, like when the maturity of the pool is only 1 to 2 years, during that period curtailments are very high. Okay, like you may make 3-4 EMI payments, or let's say you may make 30% of the outstanding principal payment instantly, immediately. And in India also, if you're taking loan from the banks, I'm not talking about these NBFCs or other third parties who are providing personal loans, okay, at any rate, I'm talking about banks. So even if you take personal loan, they will clearly specify there, okay, that okay, for 1 year you will not be able to prepay. Okay, you'll have to make the EMI payments. Yeah, they will lose interest income. They have their interest there. Okay, so they don't want you to prepay the loan before 1 year. But if you prepay, they will say that okay, this much charge will be cost applied and this and that. Okay, then after 1 year, they will give you a facility that you can either fully prepay the loan, or let's say you can make a partial prepayment, 30% or 40% or whatever. Okay, and on that they will charge a very nominal fee, maybe 1.5% to 2%. Okay, and then they also give that okay, if you have made a partial payment, then they will give you 2-3 time frames. Like okay, at 1 year from now you can make a partial prepayment. Then at 1.5 year you can make a partial prepayment, and then finally After that, at maybe 1 year, 9 months or something, you can make the partial prepayment and your 2-year loan will be closed. So this is how curtailments work. Okay. Now, whenever curtailments happen, their interest income actually decreases. And they're okay with this. Why? Because during the initial life of the, why the banks do this? Okay. That for 1 year, if you do prepayment, then we will charge more. Okay. We'll charge more as prepayment charges. Okay. As some kind of fine or whatever. So during the initial period of the loan, the principal amount is high and they are earning more and more interest. Okay. But as we have seen in the repayment schedule, amortization table, okay, which is also called repayment schedule, okay, amortization table, that as the loan maturity nears, majority chunk of the EMI is actually the principal amount and only small part contributes towards the interest payment. So they feel like, okay, I'm interest, principal amount is left is 30,000 rupees, but I'll end up earning interest of only 1,000 rupees. If I get this 30,000 now, okay, I'll issue a new loan of 30,000 where I'll be earning more interest. Okay, so they will be, that means the objective is freeing up the capital. If not more interest, then at least freeing up the capital to give out new loans. Okay, so that's why they offer favorable terms later at the stage. Okay, now in India, if I say, you will not find MBS or mortgage pools like that. We don't have that structure. But in foreign markets, like in US, European markets, these do exist. And that's why we study. So that's the end of this chapter. Now, just give me a minute. I'll open the next chapter and then we'll start. Yeah. Okay. So now we're going to start with the next chapter, that is FMP 19, interest rate futures. Okay. So this chapter is closely related to bonds and securities, where we have futures contract on bonds, on bonds specifically. Okay. And we'll see how these prices are calculated and the related aspects, like how the prices are quoted, how the trading is done, things like that. Okay. So let's start our discussion. Now, in this chapter, first we'll understand the day count convention. And we know what are day counts like. It's simply used to calculate the interest accrued, okay, or accrued interest, which means number of days between the dates divided by the number of days in the reference period, which can vary depending on the nature of security. If it's a semi-annual coupon payment bond, then the reference period can be 6 months, 180, 181 or 183 days, 182 days. And number of days between the dates, like the last coupon payment date and today, because for calculating accrued interest, this is something that we need to take into consideration. And then interest earned in the reference period. Okay, in order to find out what should be the interest for the reference, for the number of days that I am considering. Okay, now there are different conventions to count the number of days. Okay, for example, these two, number of days between dates and number of days in reference period. Basically, there are 3 day count conventions. First one is actual upon actual. Okay, that means you take actual period between the last coupon payment date and today, and the actual number of days between the 2 coupon payment dates. Okay, that's actual upon actual day count convention. Then you have 30 upon 360, and actual upon actual. I have already told you that this is used in the case of treasury bonds. Okay, for finding the price of treasury bonds. 30 upon 360 used for corporate bonds. And here I assume that there are 30 days in a month and 360 days in a year. Okay, that's the assumed flat, nothing else. So if it is April 15th, and let's say coupons are paid every 6 months. So it will be, let's say last coupon was paid on January, now next will be in the June. So it will be January, February, March, 3 months and 15 days, 3 months and 45 days, 3 months and 15 days. That's 105 divided by 180, end of the story. Okay, as simple as that. Then you have actual upon 360, where when we are counting the number of days between the last coupon payment date and today, we are taking actual number of days. But when we are counting the number of days between the reference period, in the reference period, we assume that there are 30 days in a month and there are 12 months, so 360 days in a year. And this type of day count convention is used in the case of treasury bills. Okay, so different securities use different day count conventions. Now let's understand what are treasury bond futures. So if in a treasury bond futures contract, the short position, basically, that means the seller of the underlying asset, can deliver any government bond that is between 15 and 25 years to maturity on the first day of delivery month. So let's say it's a 6-month interest rate future, treasury bond futures, T bond futures. Okay. And let's say it was in January. Okay. Now, February, March, April, May, June, July. In July, I will be settling this bond. Okay. July is the maturity month. So on the 1st of July, I will decide, I am the short position holder. Okay. So I will decide which bond will I deliver. Okay. Now, while delivering, the only criteria is that the bond that I should deliver should be a bond, a government bond, which has maturity between 15 to 25 years. Okay, in case of T-bond futures. Now the task is valuing these futures contract, finding the futures price and all. Okay, so the exchange has actually developed a procedure for adjusting the price received with the party with the short position. Because I am the short position holder, so I sell the bond, I get the price. Okay, so what price will I receive? This is actually for this, the exchange has designed a clear procedure that what you have to do in order to find out what should be the price you should receive. But in order to do that, you need to first identify what is the bond that you choose to deliver. Based on that only, the price can be decided. Okay, so let's say that you have decided the bond that you will deliver. Then in that case, there is a factor that is defined, which is called the conversion factor. Okay, now I'll tell you one thing, that on exchange, the quoted prices of the bonds, okay, on futures exchange, so futures quoted price of the bonds are actually, are actually assumed to have a yield of 6% to make it uniform. Now we know that in reality bonds do not have a yield of 6%. Some bonds will have higher yield, some bonds will have lower yield, so things like that. In order to adjust for that, the concept of conversion factor is brought in. Okay, so we know that futures quote is given on the basis of, by assuming that the yield is 6%. But my bond that I will deliver does not have a yield of 6%. So how will I find the price? I cannot find it. Okay. So for that, I find the conversion factor for that bond. Okay. That what is the conversion factor? Okay. And that conversion factor is multiplied with the most recent settlement price. That gives you the clean price of the bond to be sold. And then you add any accrued interest if there are any. And that becomes the price that the short position holder will receive. Okay, and the only reason we have the conversion factor is because of the fact that exchange decided that when I quote the futures price of the bond, it should assume that the yield of the bond is 6% per annum. Okay, and one might say, okay, why they took 6%? Of course, it was their choice. They assumed it, and accordingly they designed everything. Okay. Next, let's see how we calculate the conversion factor. So let's say contract delivery is for $100,000 of face value of bonds. Okay, so this is the face value of bonds that I'll deliver. Now, let's say the most recent settlement price is 120. Dash 00. We know this convention. Okay, if it is 00, whatever number is, we divide it by 32 and add it with this. Okay, and we can only have 2 digits here up to 32, and then after 32 it again goes back to 1, 2, 3, 4, and so on. Okay. And let's say the conversion factor conversion factor for me is 1.38. Okay, in the ratio terms. Then I also calculate that the accrued interest for me is $3 per 100 face value. So for $100,000 of face value, I can easily calculate. I can just do the mathematics. I'll get $3,000. So what is my cash received? It is the quoted futures price times the conversion factor plus AI. That is 120 times 1.38. And this is the conversion factor based on the bond that I have decided to deliver. Okay. For every bond that you wish to deliver, let's say there are 4 or 5 bonds and you want to deliver either of them. So for each of the bonds, the conversion factor will be different. You'll have to calculate it. Okay. And then you add the accrued interest, you get that, okay, you will receive $168.60 per $100 of face value of bonds that you deliver. Okay, this is the price that you will end up receiving. So that's how you find out the cash received by the short position. Now, when the future value is $100,000, the cash received will be $168,600. Now, let's see the calculation of conversion factors. So the bond maturity at the times to the coupon payment dates are rounded down to the nearest 3 months for calculating conversion factors. So the thing here is that there are multiple assumptions. First is that, let's say it's a delivery month and you find that, okay, there are 3-4 bonds that I can deliver. Okay, you feel like, okay, there are 3-4 bonds that fulfill the criteria which can be delivered under the terms. So you will first find the conversion factor. So conversion factor, in order to calculate it, you will see that today, what is the time left to maturity? So let's say there is a bond whose time left to maturity is 18 years, 5 months. Okay. So what you have to do, you have to round down this maturity. Listen to the words very carefully, not round off. You have to round down to the nearest 3 months period. So around 5 months, we have 18 years and 5 months. Forget about 18 years. Just look at the 5 months. What is the nearest 3-month period around it? One is the 6 month Another is 3 month. One is ahead, one is back. Okay. Now here I have to round down. That means I cannot take 6 month. I will have to go back to 3 month. If the time to maturity was 18 years and 7 month, okay, then in that case, I have 3 months period in around this 7 month period. One is 9, one is 6. I'll not go to 9. I'll go to 6. I need to round down. So for calculation of conversion purpose, for the purpose of calculating conversion factors, I will take 18 years and 6 months if the actual maturity is 18 years 7 months. Okay, so that's how. And if let's say there is one more thing. So these are the two possibilities. Okay, one is you need to round it down to the nearest 3 month, not 6 months. So if it is 5, it gets round down to 18 years and 3 months. If it is 7, then it gets round down to 18 years and 6 months. If it is 11, it gets round down to 18 years and 9 months, and so on. Okay. Now in both the situations, we need to look yet another thing. Then once you've rounded down, there are two possibilities. I took the example where in one case the maturity was rounded down to 18 years and 3 months, and in another it was rounded down to 18 years and 6 months. Now, if after rounding, the bond maturity lasts in 6 month periods, like 18 years 6 months, or 19 years 17 years 6 months, or 17 years, things like that, then the first coupon is assumed to be paid in 6 months from now. Okay, I'll assume that from today, after 6 months, first coupon will be paid, and then valuing bond becomes really easy. If the rounding down, if we round down and it does not come to exact 6 month periods, let's say I get 18 years 3 months or 18 years 9 months, then I assume that from 3 months from now, let's say if it is 18 months, 18 years 3 months, then I'll assume that after 3 months, first coupon will be paid. I'll move forward in time. Okay. And once I move forward, I get that, okay, now the time left to maturity of the bond is 18 years. Okay, I took another leap. I move forward. And at that point of time, I will value the bond, and then whatever the accrued interest is, I'll subtract it. Find the present value and subtract the accrued interest. Okay, that's how these are done. Now let's see an example to better understand. First, a simple one. Let's say I have a 10% coupon bond maturing in 2 years, 20 years and 2 months. Okay, so when I round it down, I get 20 years, which is a multiple of 6 months. Okay, in this case, this was the original scenario, payment scenario. 2 months, first dollar, 8 months, second, 14 months, third, and so on. And at 20 years and 2 months, final payment. Okay. Now, when I round it down for calculation purpose, I move forward 2 months. Okay. I move forward 2 months. Now this becomes my time zero. And here I have clearly at every 6 months period, I'm receiving a payment, and maturity is 20 years. Then I value the bond using a discount rate of 6% per annum, because I have to calculate I have to assume that as I said, exchange assumes that the bonds are paying a yield of 6%. Okay, so that's why 6% per annum. And I find that the value of the bond is $146.23. Okay. Next, to find the conversion factor, I simply need to divide this value by 100. Pretty simple. Okay, 146.23 divided by 100. It becomes 1.4623. Things are really easy when we have rounding down maturity in the multiples of 6 months. But when the rounded down maturities are in the multiples of 3 months, then the problem arises. So here, then it becomes a little bit more complicated, I would say. So here, let's say we have another bond, which is maturing, which is 8% coupon bond, and is maturing in 8 years, 4 months. So when I round it down to the nearest 3 month period, the maturity will be, and this is first the cash flow timeline. Okay. When this is the maturity. For conversion factor, what I do, I assume that, okay, yeah. So for conversion factor, when I round it down, this becomes my time zero. Okay. This becomes my time zero. 14 years, 18 years and 3 months. This becomes my time zero. Okay. And then I move 1 month forward. From here, I have payments happening every 6 months. Okay. I have payments happening every 6 months. Sorry. Correct. Then I value the bond. So here I round it down. I value the bond. I have the payments. I come from 0 to here, and I value the bond at this point of time. Okay, all the cash flows, like this cash flow, all these will be discounted, and this cash flow will directly be added, $4. Okay, so what will be the value here? You see, bond value will be $4 that I was supposed to receive at 3 months, and the PV of 18-year bond that is there. So it becomes 125.8323. That is the value of the bond. Then I find the interest rate for the 3 month period, assuming that the rate of interest is 3% per annum with semi-annual compounding. I find that, okay, the interest rate is 1.4889. Okay, I discount it to 3 months. You see, I was here. From here, I came here to value the bond. Okay. From 0 to 3 months, I came at this point of time to value the bond. Okay. Now I have to discount it back now because today is this. I need to discount it back for 3 months. Then I discounted it back for 3 months and I get the price to be 123.98626. Okay. Then for the last 3-month period, because here 3 months are left to get the coupon payment. So that means 3 months have passed. So I need to subtract the accrued interest for that 3-month period. And since the coupon rate is $4, so the accrued interest is $2. The clean price will be 123.98626 minus 2. That is 128.98626. And then I divide this value with the face value of the bond. I get the conversion factor. Okay. So the only difference is you have one step more. Okay. That you need to discount that. So that's how you find the conversion factor. So once you have the conversion factor, then you can find what is the cost of delivery for you. Okay. You can find what is the cost of delivery. So here, now we need to identify what is the cheapest to deliver bond. So as I said, let's say it's the final maturity month and you are like, okay, there are 4 bonds which you feel like can be delivered. Okay. Now you have to select one. So you will select that one which is cheapest for you to deliver. And how it is found? It is found using this thing. Quoted bond price minus the most recent settlement price times the conversion factor. How did we get 125 initially? Where 125? Yes, this one. You see, I rounded down the maturity to 18 year 3 months. Then I move forward 3 months. Okay, I come here. Okay, I come at this point of time. Now what happens? These are the cash flows. I value at this time. If I ignore this cash flow, then I have $4, $4 up to 18 years. So I value this bond as usual using the TVM buttons. And then I add this $4, the final coupon payment. Okay, that's how we get. So no 18.2, 18 times 2. What is 18 times 2, Devesh? I'm not able to understand. What was 18 times 2? Let me just go back. Yes, it is done. Here you see, I have come here at this point. This thing is happening. This thing is happening. I am here. Now I have only 18 periods left. So 18 payments, 18 into 2 payments have been done. Okay. So at time 0, 18 year 3 months is left to maturity. Now I move 3 months forward. I come here. So how many years are left to maturity? 18 years. I value this bond. So here, these are the cash flows that I will consider, not the cash flow that I'm receiving here. Okay. But then when I find the value, I just add it. Okay. Because I have to come to today. And this is something that is not paid. It's just for valuing this 18-year bond that we had done. Is it clear? Okay. Now, so this is the formula that we use to calculate the cheapest to deliver bond, where quoted bond price is the quoted price of the bond, actual bond. Okay. Most recent settlement price is the futures price of the bond, current futures price of the bond. And conversion factor is the conversion factor of the bond under consideration. That means the bond for which you have taken the quoted price. Okay. So let's say today that the most recent settlement price is 98.08. You can find it from the interest rate futures data. Okay, so what is the current interest rate futures quoted price? 93.08, which transforms into 93.25, 8 divided by 32. Okay. Then what you do? You consider 3 bonds. You feel like, okay, there are 3 bonds which can be delivered under the terms of the interest rate futures. These are the quoted price. Okay. Then using the previous concept, you calculated the conversion factors for each of these bonds. Okay. So these 3 bonds have these conversion factors. Now what you will do, you will carry out this calculation. Quoted bond price, that is 99.50 minus most settlement recent price, that is 93.25 times the conversion factor, that is 1.0382. This calculation will be done for all the 3 bonds. Okay. So here for bond 1, the cost is 2.62875. 6875, sorry. For bond 2, the cost is 1.871. And for bond 3, the cost is 2.1151. So naturally, you will select that bond for which the cost of delivery is lowest. And bond 2 has the lowest cost of delivery. So this is how you decide the cheapest to deliver. Okay. Now, determining the futures price, it's really easy. Once you have established the fact that you have a cheapest to deliver bond, you see, determining futures price is conditional on knowing what is the cheapest to deliver bond. And in practice, if you will see, it is difficult because you know cheapest to deliver bond only in the month or in the maturity month. So that's a challenge. But let's say hypothetically that we know that what is the cheapest to deliver bond and that price is S0. Then what we only have to do is the price of the bond. From the price of the bond, I will simply subtract the present value of accrued interest. Okay, or present value of coupon. And then it's just a simple formula that we studied in futures forward contract chapter, where we had, if we have discrete income, so we subtract the present value of income from the spot price and just compound it forward, we get the forward price. Okay, the same formula can be used here. And here we have an example. Suppose we have a treasury bond futures contract, and we know that the cheapest to deliver bond will be a 12% coupon bond with a conversion factor of 1.6. Okay, this is given to us. Now further, let us assume that the delivery will take place in 270 days. Okay, and coupons are payable semi-annually on the bond. And let's say this is the criteria. Let's say we know, this is today, we know that 60 days ago last coupon was paid. Next coupon naturally will be paid at 122 days from now, because every 6 months the coupon are being paid. Maturity date is here. And then after maturity, I have one more coupon payment. This is none of my concern. I'll not consider it. For me, this coupon payment is of interest. Okay, so how will I do the calculation? First, let's assume that the interest rate is flat at 10% per annum with continuous compounding. That means for all maturities, the interest rate is 10% per annum. And the current quoted price of the bond is 150. So what I'll do now, first I'll find the dirty price of the bond, the cash price. That is 115 plus 60 divided by, that is the accrued interest for this period. I get 116.9780. Then I find the present value of coupon. The coupon that I will receive here. Here I will receive a $6 coupon, 12% interest. I find the present value. I get 5.8077. Then I find the futures price by simply S minus present value of coupon times the compounding. The futures price becomes 119.71097. Now this is my dirty futures price because I used the dirty price to find the futures. Okay, now I need to find a clean futures price. So for that, I will subtract. You see, I had actually, next coupon is about to be paid in this period. Okay, so whatever the interest is for the upcoming period will be subtracted from the futures price. So when I subtract it, I get the clean futures price of the bond as 114.8509. And this is what you say the quoted futures price. But the calculation of quoted futures price is conditional on knowing what is the cheapest to deliver bond. Okay, which is a challenge. So you can say in a way that it's a theoretical way to find it out. However, exchange have their own methods which they can use, they employ to find out what should be the futures price. It's only the start that they have to worry. After that, market drives the price. Okay, they're not worried about it that much. So yeah, this is your clean futures price, and then quoted, this divided by the conversion factor, because conversion factor will make sure that the quoted futures price are for bonds with interest rate of, with yield of 6% per annum. Okay, end of the story. Now, next we have the Eurodollar futures. So Eurodollar futures are basically, first we need to understand what is Eurodollar. So Eurodollar is a deposit, is a US dollar deposit. Okay, is actually a deposit whose currency is US dollars, but it is deposited in bank outside USA. Okay, so let's say 1 million US dollars is deposited in a European bank. Okay, this is what we call Eurodollar, and the interest earned on this deposit is called Eurodollar interest rate. Okay, so if you deposit it in European bank, then on that deposit you will earn some interest. So the interest that you are earning on that deposit is called Eurodollar interest rate. And Eurodollar futures actually help us to exploit that interest rate, get the benefit of that interest rate. So most common Eurodollar futures that are traded are 3-month Eurodollar futures contract. Okay, where the interest will be paid on $1 million of face value of Eurodollar deposit for a future 3-month period. Okay, so Eurodollar future means, let's say today I enter into a Eurodollar futures contract, 3-month Eurodollar futures, which will start at June, not today, at June, in June. Okay, so in June, for the next 3-month period, whatever the interest is earned on that deposit is something that I'm betting on. Okay, is something that I'm betting on. So here the design is such that this Eurodollar futures contract is designed in such a way that if the interest rate increase by 1 basis point, then the value of Eurodollar futures decreases by $25. Okay, so if there is an increase of 1 basis point, you see a decline of $25, or let's say increase of $25. Okay, now future price is quoted for Eurodollar futures. The price is quoted as 100 minus the futures interest rate. So if it is said that, okay, for the June, July, August period, the Eurodollar rate will be 3%. So the futures quote will be 100 minus 3, that is 97. Okay, now a trader who is long, let's say I bought futures contract. Okay, I gain when the rate falls. Okay, and the person or the trader who is short will gain when the interest rate rise. If let's say after 3 months the interest rate rises, so I will lose money since I'm long, and the short position will gain money. If the opposite happens, then I'll gain money and the other person will lose money. Okay, and the contract price is calculated using this formula. Okay, where Q is the quoted, is the quote of the futures quote, and this is the formula to find the contract price. That means the price at which you can enter into the contract today. Okay, next you have the SOFR futures contract. SOFR futures are actually, you see, after June 23, it has been said that, okay, USD LIBOR will be replaced completely with SOFR rates, secured overnight funding rates. Okay, so what will happen now, instead of benchmarking the rates against LIBOR, the rates will be benchmarked against SOFR. So like Eurodollar futures, all the Eurodollar futures where the benchmark was considered LIBOR rate, now their benchmark will be changed to SOFR, and that's what we call it. They are now being termed as SOFR futures contract. Okay. Now CME offers 3-month contract on secured overnight funding rate, SOFR rates. Okay. And the structure is similar to Eurodollar. That means if there is a 1 basis point movement, it could lead to a gain or loss of $25. Okay. So in a way, I can say if I am long and interest rate move up by 1%, 1 basis point, I will lose 25. Okay. If it goes down by one basis point, I'll gain 25. That's how it works. Okay. So the contract month for the 3-month futures is the beginning of the 3-month period over which the interest is calculated, and the settlement is 3 months later. Okay. So here what happens in the case of Eurodollar, what the case was, so let's say June comes, I know what is the 3-month 3-month Eurodollar rate, interest rate. So at that point of time only the transactions are settled. In case of SOFR futures, let's say the contract comes into existence, let's say it was 3-month futures contract, SOFR futures, and today it starts. I know what is the 3-month SOFR rate. Okay, but it is not initiated, but the transactions are not settled today. It will be settled at maturity. That's the major difference between Eurodollar futures and SOFR futures. That's the settlement period. In Eurodollar, settlement is today. In SOFR, settlement is at maturity. Okay, and that is something that is written here. And SOFR futures can be used to hedge exposure to SOFR interest rates. So if you have exposure to secured overnight funding rates, which is now being considered as benchmark in US market, okay, instead of LIBOR. So you can use SOFR in futures to hedge against the risk exposures. Okay. Then you can also use Eurodollars to extend the LIBOR zero curve. So for that, you need to make a convexity adjustment, because we know that the interest rates are not straight line. There are some curvatures. Okay, so we need to make that adjustment. So once it is done, you can use SOFR futures to extend the zero curve. Okay, and how it is done? Using this formula. So if you want to find out the zero rate for the period, let's say you know the 3-month zero rate, SOFR rate. Okay, now you want to find out what will be the 6-month SOFR rate. So for that, what you require is the SOFR futures rate for the period starting at 3 months and ending at 6 months. That's all. And the 3-month SOFR rate today. So FI is the forward SOFR rate, RI is the 3-month SOFR rate today, and TI plus 1 is the 6-month period, and TI is 3 month. Okay, you can calculate using this formula. You can extend the curve. You can extrapolate then to calculate 3 months, 6 months, 9 months, 12 months, and so on, SOFR rates. Okay, here example has been given. So let's say you have a 400-day LIBOR, or you can say SOFR, in fact, it should have been SOFR. Yeah, it's the same thing. The formula is same. Only in place of LIBOR, now we have SOFR. That's the difference. Okay. So 4.80%. 90-day forward rate at 400 days is 5.3%. So at 400 days from now, if you enter into a 90 days SOFR futures contract, the rate of interest being offered is 5.3%. Okay. Then you want to find out 491-day zero rate. Okay, or 490-day zero rate. That is, what will it be? So you can simply take this into consideration. 5.3 times 491 minus 400 plus 4.8, that is this formula that I'm applying, and I get the answer to be 4.8927%. This is my 491-day SOFR rate. Okay, that if today I invest for 491 days in the SOFR rate, okay, at the SOFR rate, then I will end up earning 4.8927%. Okay, that's the interpretation. And with this, we have concluded this chapter as well. Now, we will start with the next chapter. Denominator should be 491. T I plus 1. Yes, sorry, it should be 491. There is a mistake actually. Okay, please ignore it. Okay, so let's start the next chapter. Just give me a minute. I'll just open the slide. So now we are into the final chapter of our today's discussion, that is FMP 20, which is swaps. Okay, now we know what are swaps. Swaps can be of different types: currency swap, interest rate swap, where one kind of interest rate is exchanged for another kind. Usually fixed interest rate is exchanged for the floating interest rate, and so on. Okay, now here we will understand like we are not going to see every details. We'll just see the competitive advantage. Okay, comparative advantage, sorry, and then how comparative advantage is used to find the swap rates for a swap transaction. Okay, then how intermediary affects the swap transaction, and finally we will see valuation of currency swap. For interest rate swap, the thing is very simple. Like you have a fixed leg and a floating leg. So fixed leg is valued as a fixed rate bond, and floating leg is valued as a floating rate bond, and then you take the difference, you get the result. For currency swap, again, you have the bond valuation method, which again I will not be discussing. I'll discuss a forward exchange rate method, which can be used to value forward currency, to value currency swaps as well. Okay, so let's move forward and let's see what all the agenda, what all we have to discuss here. Now, mechanics of interest rate swap. If we talk about a plain vanilla interest rate swap, so here what happens? A company agrees to pay cash flows equal to the interest, that is predetermined fixed rate, on a notional principle. Okay, so there is a notional principle that is defined. Principal is never exchanged because here the currency is same. So it makes no sense if you exchange the principal in the case of interest rate swap. But interest payments are exchanged. So if let's say I agree to pay fixed interest rate, so other party naturally agrees to pay, let's say, it can be fixed for fixed also, it can be fixed for floating also, but usually it's fixed for floating. Other party agrees to pay a floating interest rate. Okay. So this is a structure where what I'm doing, I'm swapping one type of interest for another, or I'm swapping one kind of income from another. And that's why these are called swaps. Okay, then let's swap the interest rate. So one side is floating rate, another side is the fixed rate, which is exchanged. Now one might say that why it is needed. So usually the floating rate of interest is LIBOR rates, which are actually used as the reference for calculating floating rates. And it is not always exactly equal to the LIBOR rate. There is some spread added depending on the risk profile and everything other factors. So maybe if let's say I agree to pay 4% and the other party says that, okay, I'll pay LIBOR plus 0.5%. Okay, that's how the things are structured. So every 6 months, you get to know what the LIBOR will be, you get to know what the swap transactions will be, and you do the transactions accordingly. Okay. Now here an example has been given. So let's say there is a 3-year swap, which was initiated on March 8, 2017 between Apple and Citigroup. So assume that Apple agrees to pay Citigroup an interest rate of 3% per annum on a notional principal of 100 million. So Apple will pay 3% fixed on 100 million. That is $3 million every year. Okay. And Citigroup in return pays 6%, 6-month LIBOR on the same notional. Okay. Here we are just ignoring spread for the time being, just to keep the calculation simple. Okay. So whatever the LIBOR is, yearly LIBOR. So today, if a transaction has to be done today, let's say I want to know what will be the swap transactions after 1 year. Okay. So it can be known because today I know that the swap rate is this much and I know the LIBOR is, okay, let's say, for example, 3.9%. So I know that, okay, after 1 year, I will receive 3.9 and I'll pay 3%. Okay, that's how things are decided. Now, this is the swap, basic swap transaction. Like Apple pays 3%, Citigroup pays LIBOR. Every 6 months, okay, 3 year swap, Apple will pay. Okay, so here it is not written that, okay, it will be 6 months, but let's say, okay, it is 6 months. So every 6 months, $1.5 million will be paid by Apple to the Citigroup. Okay, because that is Apple is paying the fixed. And if let's say 6-month LIBOR rate on the March 18, 2020 is 2.2%, then Citigroup will pay how much? Citigroup will pay $1.1 million at 6 months from now. Okay. Now, regarding the fixed payments, I know precisely what the fixed payments will be throughout the life of the swap contract. That will be 3% per annum with semi-annual compounding. But regarding LIBOR, I only know what will be the payment at 6 months from now, not beyond that. Because the payment that I will receive at 1 year from now, okay, will be calculated based on the LIBOR rate that is prevalent at 6 months from now. And this is a future period. So I don't know what this rate actually is. So I can't calculate what my floating payment will be at 1 year from now. Okay. And that's why these are actually considered equivalent to floating rate notes. Okay. Inflating rate notes also something like this happens. Okay. Where we know what the coupon, what is the rate of coupon for the next 6 month period, for the current 6 month period, but I don't know what will be the coupon for the period after that. Okay, so once this 6 month period passes, then only I will get to know that what is the coupon rate for the next 6 month period and so on. Okay, and accordingly they are valued. Now here, if things are considered, let's say we have a 6 month LIBOR that suppose that the 6 month LIBOR rate on September 8th, 6 month passes, we are on September 8th and it turns out to be 2.8%. So on this date, I can then calculate that, okay, at 1 year from now, I will receive $1.4 million. So March 8th, I know the LIBOR. Now let's see what will the cash flows. On September 8th, I know it will be 1.1 million and 1.5 million. On for the cash flow for March 8, 2018 will be known on September 8, 2017. So the rate prevalent on September 8, 2017 will be used to calculate the cash flow for March 8, because this is the period for which I'm calculating the rate. Correct. So I need to know what is the rate, 6 month rate on September 8, 2017. And accordingly, I can find out what is the net of the cash flow and then done. Okay. However, this is a scenario which is hypothetical because I know and that if this is today, March 8, 2017 is today, I don't know what will be the LIBOR rate on September 8, on March 8, 18, on September 8, 18, and March 8, 19. I don't know what the rates are. Once these dates come, okay, as the day pass and I reach on September 8, okay, then only I'll know that, okay, today the 6 month rate is, 6 month LIBOR is 2.8%. So the cash flow for March 8 will be calculated using this rate. Okay. Now, let's understand what are overnight indexed swaps. So as we know that LIBOR is being phased out, so swaps are now being based more on overnight rates. Okay. And hence they are, since they are based on overnight rates, they are called overnight indexed swaps. Okay. Like SOFR, secured overnight funding rate. It's an overnight indexed swap. It's an overnight index rate. So if you are basing your swap transaction on the SOFR rate, then it is considered overnight index swap transaction. Okay. Now, a key difference between LIBOR swap and OIS swap is the time when the rate paid is known. Okay. So in the case of LIBOR, you know at the beginning of the period that what will be the payment at the end of the period. Because today you will know what the 6 month rate is. So you can calculate what is the interest amount that I'll receive at 6 months from now. Okay. On the other hand, the OIS rate is not known for the period until the end. Okay. So here what happens, you know what is the 6 month rate today. But in case of OIS, as the day passes, okay, and we reach maturity, we reach the next coupon payment period, we look back and we find out that over this 6 month period, what was the average borrowing rate, average overnight index rate. And that is used to calculate the interest payment on the same day, on that specific day. Okay, so that's the difference. In case of LIBOR, we know today itself that what is the payment, we don't know the today only, that what the rate is. But in case of OIS, we don't know the rate today. We will know it only when the 6-month period has passed. Okay, so that's more added complication. Now, OIS that last for a year or less typically lead to a single exchange at the end of the life of the contract, while OIS lasting longer than a year involve quarterly payments. Okay, so that is the property of overnight index swap. So if you have an OIS which is maturing in 9 months, usually it will have only one payment at 9 months from now, end of the story. But if it's a OIS, let's say maturing in 3 years or something, then it would require like making swap payments, like making exchanging payments every 3 months. Okay, typically that's a typical structure, standard. However, in OTC market, you can have other variations. Okay, now let's understand what is the comparative advantage argument. Okay, so you see, it's not for us again, I would say, but for big institutions, there are possibilities that they can borrow at the fixed rate also and at the floating rate also. Okay, so there are two interest rate markets, fixed interest rate and floating interest rate markets. Now let's say there is a company, two companies, company A and company B. Now in fixed rate market, company A is being offered a rate of 3.5%. And in the floating rate market, the company A is being offered a rate of floating rate, whatever it is, be it SOFR, LIBOR, whatever, plus a spread of 0.1% or 10 basis point. Okay. On the other hand, company B, okay, on the other hand, what happens? Company B is being offered a rate of 4.9% in the fixed interest rate market and a rate of floating plus 0.9% in the floating interest rate market. Okay, now let's understand one thing. Let's see the advantage. Okay, from the perspective of company B first. So if you look at company B, what company B will look? Okay, I am being offered 4.9% in fixed market, but company A is being offered 3.5%. So he is getting a benefit of 0.6% more. Okay, he is getting a benefit of 0.6% more. But in the floating market, he is getting a benefit of how much? He is getting a benefit of 0.8%. Okay, he is getting a benefit of how much? 0.8%. Okay, because company A is paying 0.8% less. So company B feels that, okay, in fixed market, I have to pay only 0.6% extra compared to company A. Okay, so in comparison to company A, company B finds that it has favorable terms, favorable interest rate being offered in the fixed market. Okay, compared to the floating market, because in floating market, he had to pay 0.8% more than company. But in fixed market, he is only paying 0.6% more. So he has a benefit of 0.2% in by borrowing in the fixed market. But let's say that company B wanted to borrow in the floating rate. Okay, but because of the comparative advantage, what this company did, it ended up borrowing at the in the fixed market at 4.9%. But the objective was to borrow at floating rate. That has not been fulfilled. We'll come to that. But first, let's understand now company A. Now, company A sees that, okay, in the fixed market, I have a benefit of 0.6% compared to company B. But in floating market, I have a benefit of 0.8%. That means I'll pay 0.8% less than what company B is paying. Okay. And here, naturally, the difference, you see, 4.9 minus 3.5. Oh, sorry, it's 1.4. Yeah, sorry. Yeah, that's my bad. I actually did it right. I didn't do the right calculation. Yeah, 1.4%. Okay, 4.9 minus 3.5, 1.4%. So in that case, the scenarios will change actually. Okay. Yeah, in that case, the scenarios will change. So here, company B is paying 4.9% more. Okay. 1.4% more than company A, but here he is only paying, company B will only be paying 0.8% more. So company B has an advantage in the floating market. Correct. So company B borrows in the floating market, but company A sees advantage in the fixed market. Okay. So company A borrows in the fixed market. So let's see what has happened. Company B borrows in floating, company A borrows in fixed. But let's say hypothetically that company B wanted to borrow in fixed and company A wanted to borrow in floating, the opposite. Okay, that were their expectations, but they ended up, because of the comparative advantage, buying in the opposite markets. Okay, or borrowing in the opposite markets. So how will they do this? Okay, company B wanted to borrow in the fixed rate, ended up borrowing at floating. Company A wanted to borrow in the floating rate, ended up borrowing in the fixed. So what they will do, they will enter into a swap agreement. Okay, and how the swap is created, we will see that. So let's see. These are the benefits. Delta fixed 1.4, delta floating 0.8. A has comparative advantage in the fixed market and borrows at 3.5%. Okay. Similarly, B has comparative advantage in the floating and borrows at floating rate, that is floating plus 0.9%. Okay. Now the problem is A actually wanted to borrow in floating, but because the terms were not favorable, ended up borrowing in fixed. B actually wanted to borrow in fixed, but since the terms were not favorable, ended up borrowing at floating. Now, what's the way out? How will they fulfill their objective? So for that, swap agreement, swap contract comes to rescue. Here, what happens? Swap can help companies to transform their liabilities. Suppose A and B enter into a swap directly, where B pays fixed rate of X% and A pays a floating rate. And the structure will look like this. Okay, company A took a loan at 3.5%. Okay, then what this company does, enters into a swap agreement where it receives a fixed rate and pays a floating. Now, what is the net of this? If you will look, 3.5% plus floating rate minus X%. Now, these two are fixed rates. Okay, they will more or less cancel out one another and there will be some spread. So effective rate that the company ends up paying is actually the floating rate plus some spread. If X turns out to be 3.5% exactly, then this liability of 3.5% has been effectively transformed into a floating liability. Okay. Similarly, and what is the net improvement received here? It is floating plus 0.1%. That was the rate being offered to A minus the rate it ended up paying. This is the rate A ends up paying. That is floating plus 3.5 minus X%. So this is the net improvement, which when simplified gives X minus 3.4%. I don't know what the swap rate is. The swap rate X, that will be the fixed rate that will be transferred, exchanged. Then let's look from the perspective of B. B ended up taking a loan at floating plus 0.9%, but his objective was to take at fixed rate. So what he does, he enters into a swap where he agrees to pay fixed and receive floating. What is the net of this transaction? Floating plus 0.9 is he is paying. Then again, X is something that he is paying and he's receiving floating. So he ends up at X plus 0.9% as the net interest rate being paid. So you see, again, a floating transaction has been converted into a fixed transaction, X plus 0.9. Okay, for B. And for B, what is the improvement? For B, the improvement is if he took directly the loan in the fixed market, he would have paid 4.9. But here he pays X plus 0.9. So the net improvement is 4 minus X%. This is the net improvement for B. Okay. So for A, let me just go back. Net improvement is X minus 3.4. And for B, net improvement is 4 minus X. Okay. Now let's find what is the total of net interest rate improvement. So I sum them all. X minus 3.4 plus 4 minus X. I get 0.6% is the total improvement. Now this total improvement is distributed between the two. Half improvement is taken upon by company A and half improvement is taken upon by company B. So 0.3% improvement for company A and 0.3% improvement for company B. Okay. Then what we do, we have the complete structure here. Company A, 3.5% liability, company B, floating plus 0.9% liability. Then this transaction, exchange, B has transformed its liability into fixed and A has transformed its liability into floating. Now, for both the sides, improvement has to be equal. That is, X minus 3.4 has to be equal to 4 minus X. Okay, then only there will be an agreement. If one is getting more benefit, then why will they do the swap transaction in the first place? Okay. So we find, when we solve this, we find that X equals to 3.7%. So the swap rate will be 3.7%. And then my transaction will be, and each one of them get a benefit of 0.3. Okay, how? Let's see. Here.
3.5 from company A, 3.5 paying, X is 3.7. Okay, 3.7 receiving, 0.2, and then paying floating rate only. Okay, so what is happening here? Floating minus 0.2. What was the rate being offered? Floating plus 0.1. You see, floating plus 0.1. Take the difference. You get 0.3. That's the improvement they get. Okay. Then from company B, floating plus 0.9 and then receiving floating. Okay. And then paying X. For them also, when you do the maths, you will find that, okay, the calculation turns out to be 0.3% improvement. Okay, that's how it is done. Now, if let us say I had an intermediary which asked for a commission of 0.04%. Okay, suppose the fee is 0.04%. So in that case, the interest rate improvement for both of them will be 0.028. Okay, for each one of them, because 0.03 was the improvement for each one of them. Now they have to sacrifice, they have to give 0.04% as commission. So both of them will contribute to equal commission. So 0.02 will be subtracted from the benefit of each one of the parties. So net benefit becomes 0.028. And the new interest rates, new swap rates for A and B will be 3.7 minus 0.02 and 3.7 plus 0.02. Okay, and the transaction will look something like this. And the difference of 0.04% is actually the commission of the intermediary bank, or the fee of the intermediary bank. So this is how we apply comparative advantage argument to find out the swap rates. Okay, now let's move forward and let's see valuation of interest rate swaps. So when initiated, swap usually have zero value, because at that point of time I know what the LIBOR rate is or the floating rate is. So we design the swap rate in such a way that it has zero value. But as the time passes, floating rates can change. Swap rate will not change. Okay, for that specific swap contract, the fixed rate will not change, but the floating rate associated will change, and that can lead to a scenario where the swap can have a positive or a negative value. And swap can be valued by comparing it to a new swap that can be initiated today and will have a value of 0. Okay, so what you can do, it's just like valuing a forward contract, if you remember. Okay, so in forward contract, what happened? Let's say forward contract was initiated some time ago. At that point of time, it had a value of 0. Now, if I had to find the value today, so what we used to do, we created a forward contract today, which had a maturity equal to the time left to maturity of the existing forward contract. And then we took the difference between the two to find out what the value of the existing contract is. Similar logic is applied here. Here, let's say we have a 4-year swap contract, which was initiated 2 years ago, and the fixed rate was 4%. Okay, that was being received. I am receiving 4%. And 3-month floating rate is being paid on a principal of $100 million. Okay, 3-month floating rate. So this 4% is yearly rate. So every 3 months I'm receiving 1%. That's the thing that is happening. Now today, let's say the time left to maturity is 2 years. 2 years have passed. Now suppose further that if today I create a 2-year swap, the swap rate should be 2.96%. Okay. Now for valuation purpose, it is assumed that the position it is taken in 2-year swap today, where the fixed rate is 2.96% is paid and the floating rate is received on the same principle. Then what you do, you take the difference. Net position will be inflow of 4% minus 2.96%. That is 1.04% of $100 million. And when you solve it, you get $260,000 as the value of your swap. Okay, and since you have a positive value, that means you have a credit exposure here. Okay. Now, if let's say I assume that the risk-free rate is 2.4% per annum with quarterly compounding, then I can value the position as $260,000 on each of the dates. I have these are made quarterly payments. Okay, for the next 2 years, that means there will be 8 payments. So I consider all of them and I discount them together. Here the number is wrong, just ignore it. 1.006 raised to the power of 8 it will be. Okay, not 3. The final one. And then I find that the value is $2.024 million. Okay, so what happens here is that I get, okay, what is the net cash flow? Okay, what is the difference between the cash flow from the existing swap, which has 2 years left to maturity, and the new 2-year swap, which can be initiated today? And this is, I assume that, okay, this will be the scenario. So I find that every 3 months, this will be the inflow when I take the net of existing swap and the new swap. Okay. And these are all hypothetical. You are not actually taking any position. Okay. It's just for the valuation purpose. And then you know the risk-free rate. You just discount all the cash flows and you find the value of the swap contract. That is $2.024 million. Okay. Next, this method can be used to value swaps involving any floating rate, because floating rates are basically getting cancelled. You might say that, okay, Subham, why we are not considering the floating rates? So you see, this side floating rate is being cancelled by floating rate on this swap. 4-year swap is being cancelled by the floating rate on this swap. Why? Because here in the 4-year swap, you were receiving the fixed. That means paying the float. Here you are paying the fixed. That's why you are taking the difference, right? You are assuming that you will pay the fixed. So naturally you will receive the float. So here you are paying float, receiving float. They cancel out. So there is no need to worry about what happens to the floating leg. Okay. We can only focus on the fixed leg and find out what the value of the bond is. Oh, sorry, what the value of the swap is. Okay. Next, let's talk about currency swaps, and probably fixed currency swaps. So these are the currency swaps where you exchange a fixed rate of return on one currency for a fixed rate of return or rate of interest on another currency. Okay. And in case of currency swaps, principals are actually exchanged because your principals are defined in different currency. Let's say you are doing a USD and EUR currency swap. So what will happen? Let's say you will pay interest on euros and you will receive interest on dollars. Okay, this is the scenario. So it is a scenario where actually you are borrowing euros and you are lending dollars. Now these are different currencies. So that's why there will be transactions happening. Principals will be exchanged twice, one at the initiation and then one at the end. Okay. It's not like the simple interest rate swap, because in interest rate swap, transferring principal makes no sense. It's denominated in the same currency. So even if you exchange it, it makes no difference. Okay, just one transaction will increase. And who wants to do that? Nobody. Now, let's consider a hypothetical 5-year currency swap agreement between British Petroleum and Barclays. Okay. And it is entered on February 1, 2017. Interest rate payments are made once every year. That means every year you will make one interest payment. Okay. And the principal amounts are $15 million and $10 euros, 10 million euros. Okay. Dollar in euros. Okay. So what will happen here? Barclays says that, okay, I will pay interest on, sorry, it's not euro, it's pound. No? Yeah, sorry. I'll pay interest on pound, and British Petroleum said that I'll pay interest on dollars. So it's a scenario where Barclays is borrowing pounds and British Petroleum is borrowing dollars. Okay, that's why British Petroleum is paying interest on dollars and Barclays is paying interest on pounds. Okay, and let's say these are the rates decided, that British Petroleum will pay 3% per annum on dollars and Barclays will pay 4% per annum on euros. Okay, it's a swap transaction. Now I want to find the scenario, like what are the transactions happening. So at the initiation, when the swap contract is initiated, at that point of time, Barclays will pay $15 million to British Petroleum, correct? Because then only British Petroleum will pay interest, and British Petroleum will pay 10 million pounds to the Barclays, okay, as loan amount. This is the first transaction that happens at time 0. So in case of fixed, in fact, in any currency swap, there is a transfer of notional principal. It's not simply notional, it's actual transfer taking place. Okay. Now here, let's see the cash flows. And we are talking it from the perspective where we are seeing it from the perspective of this US company. Okay. So sorry, from the perspective of British company, British Petroleum company. So it is receiving 15 million and it is paying 10 million. Okay. Now on February 1, 2018, after 1 year, they pay this much amount and they receive this much amount, and so on. This happens. And then finally at maturity also, principals are exchanged at the then prevalent exchange rates. For the sake of simplicity, here I am assuming that the exchange rate is same throughout this 5-year or 6-year period, whatever it was. Okay. And that's why $15 million is they give back, British Petroleum give back, and $10 million, 10 million pounds they receive from the US company. Okay, that's how things work. However, in reality, these exchange will happen at the then prevalent exchange rates. Okay. Now, let's see how we value it using forward exchange rates. So for that, we need to calculate what the forward exchange rates are. But first, let's understand the scenario that we have here. So scenario says, suppose we have two companies A and B, and they enter into a fixed for fixed currency swap with periodic payments annually. Okay. Initially, company A pays principal to B of $150 million. So A paid B 150 million. That means A will receive dollar interest and B pays 100 million euros to A. That means B pays $100 million to A. That means B will receive euro interest. Okay. At the outset of the swap, company A pays 5% in euros. Of course, B will receive euros. So A is paying euros and company B receives 7% US dollars. Okay. Now that's the, and company B receives, company A receives. Here it will be A. Okay. And sorry, just company A pays 5% euros to company B and receives 7% in US dollar. Yeah, it is correct. It's correct. The initial exchange rate was $1.5 per euro when the swap was exchanged. Find the value of the swap using forward exchange rate method when the remaining life of the swap is 2 years and the exchange rate is $1.3 per euros. Okay. Now, after 2 years, like I know that today the remaining life is 2 years. I want to value what is the value of this swap contract. And for that, I will use forward exchange rate method. And for this, let's say I have the information that USD risk-free rate is 4% and Euro risk-free rate is 3%. Okay. Then payment made to A is 7% of $150 million, that is $10.5 million. And payment made by A. Okay, what is the payment made by A? Is 5% of 100 million euros, that is 5 million euros. Okay, this is the payment made by A. Now, I will calculate the forward rate for both the years. For year one, it will be simply this put call parity I have applied, covered interest parity we have applied, and we get the forward rate for year one. Then we calculated the forward rate for year two using the same assumption. So I know that at 1 year, the US dollar exchange rate, US euro exchange rate will be, dollar euro exchange rate will be $1.31 per euros and $1.3254 per euros at the end of year two. Okay. Next, I will find out the first exchange, value of first exchange that is happening 1 year from now. So value of first exchange will be $10.5 million I'm receiving and I'm paying 5 million euros. So what will be this 5 million euros in dollars? I will find its value using the forward exchange rate because this is the exchange happening at 1 year from now, not today. Okay. I get the value of transaction to be 3.937. Then the second transaction, I will be receiving 160 complete along with the principal, $150 million principal and $10.5 million interest because 2 years is left to maturity. In the second year, I'll receive everything, my principal along with interest. But at the same time, I will pay the principal along with the interest in euros. So 105 million. What is 105 million in dollars? Again, using the 2-year forward rate, I find what is the value. This is the cash flow value at 2 years from now, 21. Okay. Now the thing is, this is the value of transaction at 1 year from now. And this is the value of transaction that will happen at 2 years from now. I want to find the value today. Natural thing to do is discount these at the domestic risk-free rate. So US risk-free rate was how much? It was 4%. So I will discount these values at 4%. First cash flow will be discounted for 1 year. Second cash flow will be discounted for 2 years. I find the value to be $23.5091 million. So for the US company, the value of this swap contract today is $23.5091 million. That means US company has a positive value. So I have a credit risk exposure towards the European company. So I will ask for a margin requirement there. Okay. Now that's the end of the lecture. And with this, we have completed our discussion on today's on FMP remaining chapters. So I hope you guys were able to understand the concepts. It was really nice talking to you guys. Have a good day, all of you. All the best for your exams.